Good evening, everyone, and welcome to the webinar tonight. My name is Richard, and thank you for attending this session. Now, before we begin, if you'd like to be kept posted of the various events or market insights by the organizer as well as the speakers for tonight, on the screen, you can see all our Telegram channels that you can join by searching for Online Traders Club, WealthEnjoy, Retirement, Wealth Lions, and TR2MIN. All right, so thanks for supporting us by coming today. Now, again, my name is Richard, and before I begin a session, I always like to ask this question. How is the market doing? Right? I know we are doing this virtually, so you won't be able to answer me, but it's either up, down, or sideways, right? And then now with Trump in the president's office in US, wow, the market has just been moving around quite a bit. Yeah, so I call it jittery. So what do I mean by that? Let's take a look at this chart. Right, I captured this chart after yesterday's SPX market close, and you can see that generally it is on an uptrend, right? Making higher highs, higher lows, higher highs, and higher lows. But it's been struggling recently, especially ever since after the election, as you can see from this first vertical line on the left. Okay, so it has been chopping sideways. Then just recently when Trump entered the office, wow, the market chopped even more with his policies, right? His tariffs and his very aggressive policies. So I'm not the expert, so I can't analyze the macros for you. I can only look at the chart and tell stories from the chart. Now, from yesterday's close, we can see that the MACD at the top, which is using the parameter 534.5, has just turned down, what we call a death cross. On the same day, the usual typical MACD 1226.9 also have a death cross. So this suggests that the bearishness have crawled into the market. But it's not saying that there's a crash or what. It's just that the uptrend may paused, right? Have paused. So we will need to see whether we can form a higher high on the chart or a lower high on the chart. Then we can tell whether the SPX is going further up or not. All right. So let's move on. Now, would you like to have an additional tool to analyze the US market? Right? The answer is yes. Then I want to share with you the tail that wags the dog. Now, who is the tail? The tail is the options market. And who is the dog? The dog is the stock market. Now, why is the options market wagging the stock market? That's because in the last 20 years, the options market volume has increased tremendously. And especially since COVID, it's been increasing by leaps and bounds to the point where the options market is having a very significant impact on the stock market. And that's why I've created this Fear and Greed Index that I name as WealthEnjoy Fear and Greed Index. It is a proprietary algo that analyzes the options market to quantify the SPX market sentiment. So it comes in the form of an oscillator, the blue color line that jumps up and down, that oscillates up and down below zero. When it is above zero, it is in a greed zone. And when it's above 50, it is in the extreme greed zone. And likewise, when it is below zero, it is in the fear zone. And when it's below minus 75, it is in the extreme fear zone. Now, personally, I really like to use this FGI, Fear and Greed Index, when it is below when it is in the extreme fear zone. That means below minus 75, because it seems to help me spot the SPX bottom. As you can see here, from where the arrow is pointing, when the FGI is below minus 75, it usually suggests that the SPX is also making a bottom. in double quotes. All right. So let's look at this chart in the last 1 year. We can see that whenever the the FGI goes below minus 75, when we look up at the gray line, which is SPX, it is making a bottom, right? Whenever the FGI cross below minus 75, SPX is making a bottom, all right, at least in the near term bottom. So if you like to also do bottom fishing, or you like to buy long-term SPY, then perhaps you can use FGI as one of the tools to guide you in your analysis. Then for people who like to sell options premium, then maybe whenever the FGI is below zero, the likelihood for the premium to be more rich will be when FGI is below zero. And if you're holding long positions, then you can be quite comforted whenever FGI is above zero. All right. So if you like to receive this FGI, WealthEnjoy Fear and Greed Index, simply join the WealthEnjoy Telegram channel, and I'll be posting it there, especially whenever it crosses into the various zones. And now, to share with you more about the organizer for today, OTCS, it stands for Online Traders Club Singapore. We are a non-profit society formed in 2005, and we are a community of traders and investors, majority of us here in Singapore. Now, OTCS to me is a place where we network, share, and learn, and we do it through a series of workshops and webinars, courses, as well as our library. For workshops and webinars, we aim to have about 6 to 10 a year. It is free for our members. And here are some of the physical workshops and seminars that we hold before COVID. This is after COVID. And for courses, we aim to have about 2 to 4 a year. And normally we will approach trainers or course providers, and we will do a group buy. We'll ask for a group discount for our members. And for our library, we have over $6,000 worth of resources, but it was closed since the COVID, and we have yet to open it. But if you'd like to find out what are the resources that we have, you can go to our website and click on the link to download the PDF of our resources. So again, to me, OTCS is a place where we network, share, and learn, and we do it through a series of workshops, webinars, courses, and our library. Now, the normal fee to join us as a member is $120 a year. And for a time-limited period, for a long time already, it's been just $60 a year. And since COVID till now, we have kept it free for our members as well as for the public. So enjoy it. So to find out how to join OTCS, simply visit our website, onlinetradersclub.org. Now, if you'd like to be kept posted of upcoming free workshops or webinars, please join OTCS Telegram channel by searching for Online Traders Club, or join our mailing list on our website. And if you're watching us on YouTube, please remember to like, subscribe, and share. And again, if you are just joining us, please support us by joining our Telegram channels, respectively, of the media partners as well as our speakers for today. Online Traders Club, WealthEnjoy, Retirement, Wealth Lions, and TR2MIN. And last but not least, I'd like to have a shout out to our OTCS crew. They are the unsung heroes who help us out during our physical events. You know who you are. Thank you very much for supporting us. And now for the most important slide. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS's opinions. OTCS, its office holders, associates, sponsors are not responsible nor liable for your losses. And OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. And today, the agenda is OTCS Outlook 2025. It is my privilege and pleasure to invite three very special guests and also my dear friends to share with us their insights. What should we do in 2025 and under Trump 2.0? Right? So first we have V, who is an ex-fund manager with a peak billion US dollar AUM. And second will be Mr. Kenny Low, who is a risk expert and a licensed advisor. And third, Mr. Ian Low, who himself is a passive income investor as well as a remiser. So I hope this lineup that we have tonight for you will be able to give you some ideas, some guidance into what we can do and under the Trump 2.0 economy. So without further ado, let me now share with you that you can ask questions after every speaker. I will be posting your questions to them. I'll be selecting the questions that you have to ask them on your behalf. So if you have questions during the sharing by the speakers, please type them into the chat box that you see on the bottom right of your screen if you're watching us on the browser, on the computer. If you're watching us on the mobile devices, then please scroll up or down to look for the chat box to type in your questions anytime. So after each speaker, I will select the questions and ask them on your behalf. So without further ado, let me now hand over the stage to V to share with us his market insight. V, please take over the stage.
Thank you. Hi, thank you, Richard. Let me just load up the slides. Okay, so hi, everyone. Thanks, Richard, for the introduction and for the invitation to speak to your community.
V,
I've
I
heard
haven't seen your screen yet, sorry.
You haven't seen?
Okay, it should be coming up. Give you a few more seconds. Yes, I
Okay.
see it. Thank you. Sorry. Please
Okay,
continue.
sorry, I'm logging in from Europe. Maybe the internet in the old world is much worse than in Asia. Thank you for taking time out on a Saturday evening to share your time and discussion with us, and hopefully some questions and views as well. I'm going to be speaking today about, as Richard pointed out, what's going to happen for in the world of Trump 2.0, right? This is the version 2 of the Trump administration, and I'll be talking about trends that are inevitable, and there are some quite likely scenarios in the year ahead. So briefly, before we go on, the usual disclaimer: this is just for educational purposes. It's the views and opinions of myself and my team. It does not constitute investment advice. You're responsible for your own investment decisions, and as Richard said, seek help if you are in doubt. Seek professional help, right? And none of this material belongs to us, and it's not to be copied or transmitted. Anyway, my name is V. It's kind of like a very simple name, and yes, my name does look like I'm from Vietnam, but I am Malaysian. I've lived much of my life, my professional life, in Singapore as well. I started working in New York, in London actually, and then moved to Singapore and then to New York for JP Morgan Chase. And I started a hedge fund in 2004. Later on, I joined Deutsche Bank and Morgan Stanley as the head of trading teams in both Singapore and Hong Kong, running the Asian FX and interest rates trading teams. So in 2016, I founded Track Record. As way of introduction of what Track Record is, we started off providing trading programs to professional traders in banks as well as in hedge funds. And I found there's a big gap between the expertise in the retail sector, investors at home, from the investors in banks and in Wall Street and in London, Hong Kong, and Seoul, right? But it is my intention to demystify how to look at the world through the lens of global macro, through the lens of how financial traders in the financial centers of the world look at the markets. So I call it it's called the global macro trading style. And what's all about is there are some pillars of some of uh, global macro, where we look at the monetary policy, political situation, geopolitical situation, as well as overall economic conditions and fiscal policies of governments to see how it's affecting the world, right? So the main drivers for the year, as always, as it's been for the last 2 years, is about what the Fed is thinking, right? So the Fed is the U.S. Federal Reserve. That's a central bank of America, and it is how the Fed thinks and how it conducts policy has an impact on how the world, the financial conditions of the world behaves, as how the markets in the world behave. As we know, U.S. is the largest economy in the world, and it drives most of the markets in other countries as well. And what the Fed is thinking is very, very important. And what they've been saying this year is very consistent. And then we'll move on to the political part, which is Trump. And it's as Richard has mentioned, this is Trump 2.0 is very different from Trump 1.0, where it was pretty much disorder and chaos for 4 years. And I'll highlight the differences between Trump now and Trump administration before. And we'll talk a bit about AI and tech as well. So what is the Fed thinking? The Fed recently, their message has been, so the Fed speakers, they're members of the Fed committee, which make the policy decisions. And on the committee, there are voters and non-voters. So the voters, some of their recent comments are that we have made progress on inflation and risk remain, and policy adjustments should be gradual. This is from the Fed chair, Jerome Powell, who is basically the main guy on the committee, and he has been driving the committee decisions with near to without dissent, right? It's close. It's only recently there's a bit of dissent, but generally they are all sharing the same frame of thinking and the thought of the policy path going forward. So one of the board members as well, just a few, most of them are very much aligned right now, and but their message is pretty much around the economy is strong. We need to be cautious about moving too quickly, and policy remains data dependent, and we are operating in a very uncertain environment. So from all this, we see that they do not seem to be wanting to change policy, right? And that is very consistent with what they have been saying. They are saying that policy is restrictive, meaning its interest rates is high enough to slow the economy down, but inflation is still above the 2% target. So we are okay with having restrictive policy because the economy is strong. We don't mind slowing down a little as long as we continue to drive inflation towards the 2% target. As you know, the U.S. Federal Reserve, the central bank, has two main mandates. One is to make sure that inflation is below or at the target, close to the target, and that the economy has full employment, means there's a lot of jobs to be available, but not so much as to cause inflationary pressures. So right now, they are both the mandates are now in the minds of the Fed voters. Previously, in the year past, when it was almost automatic cutting of interest rates, it is not about the inflation mandate, because inflation was going towards the 2% target, so they are cutting interest rates, and they're now as worried about the job market slowing down too much, or as of inflation being too sticky above the 2% target. And when they were hiking rates, it was pretty much automatic, just hiking interest rates, because inflation was so much higher than the inflation target at 2%. and they were not worried about the jobs market at all. So now we are at balance of the both mandates. And as you can see, this chart is a probability of interest rate cuts by the end of this year, or based on the interest rate products, right? Based on interest rate futures in the US bonds, as well as the short-term interest rate futures market. So there's a lot of numbers here, but essentially says 4.25 to 4.5 is where the right hand most bar is where the interest rate policy, the benchmark interest rate currently is. And by the end of this year, there's probabilities of 30+% is cutting only one cut, 30%, two cuts, right? So on a whole, it's complicated, but basically it means roughly around 1.5 cuts of 25 basis points is what the market is expecting based on the economy, based on the inflation forecast, as well as based on what the Fed is telling us about their thoughts, about their thought process. So not a lot priced in, but likely what has been happening so far has been the reduction of expectations. So we came in a few months ago, there was many more cuts priced in for this year, but now it's getting less and less because the economy remains strong, inflation remains sticky, and most of all, the Fed is worried about what Trump will be doing in the next 4 years, right? Especially about the tariffs and the intention to be more confrontational with other trade partners. So the key takeaways is that like the Fed is likely to keep interest rates unchanged or cut rates minimally. And unlike last year, which was the start of a series of projected rate cuts, now it is highly data dependent. So you'll hear this a lot when you read the newspaper or you read the financial press. I'm not sure anybody read newspapers anymore, but social media, financial press, whenever the Fed voters are quoted, even the non-voters or the board members, they are all saying, we'll see how the data shows, what the data shows before we decide on what to do. We are not doing any forward projections. We're not thinking of doing a series of cuts or a series of hikes or staying the same now. So when the facts change, they will change. So they want to maintain policy because of the uncertainty of inflation. Inflation remains above the target, but later you see that it's projected to go lower in one of the presentations in forward. But Trump's policies as well is a wild card, right? Trump has many different kind of policies, some at odds with each other, but generally what the Fed is worried about, which somehow they are not supposed to be worried about political maneuvers and all, but they are factoring this into their thought process. Tariffs and deregulation. Tariffs will cause inflation if prices go up for all the consumers in the US, and deregulation is a good thing, but they're not sure of the impact on inflation. So they are very worried. And in fact, they did something quite odd towards the end of last year. They projected much higher inflation than they previously did after Trump won the election, because they think, oh no, maybe more of these tariffs will cause inflation to go higher. So they shifted their inflation projections because of the Trump victory. So that's a little bit weird in my opinion, because they're not supposed to be doing something like this, but it is what it is, and so we have to deal with that. So no rate cuts projected, no aggressive rate cuts projected. But why is the stock market going up still? Of course, this excludes the sell-off yesterday, but previous to this, it was going up every day for quite some time. But all this going up, in the midst of going up, there's always this sell-offs, right? And that's why the environment has been quite difficult. And I guess that's why you need to look at Richard's fear index as well, because it shows you how much optimism and pessimism there is in the market. But generally, what we have been seeing is that stock market continues to go up, although there has been no rate cuts recently, right? So is monetary policy supportive of rising stock prices, rising asset prices? That's a question that you need to ask through the lens of global macro. What is it? why is the stock market going up although there's so much uncertainty and there's no rate cuts? So if you are following the news for the last few years, it was quite obvious that when the Fed was cutting interest rates, the stock markets would do well. But now that they're stopped, why is the stock market continue to do well, right? Why does it continue to do well? So for this, we have to look at something that I think most observers don't spend so much time on, which is the US bond market, right? It's what US 10-year yields means. It's essentially the effective interest rates that the US government is paying on their 10-year debt. They borrow money from the market, and the 10-year benchmark is around now 4.45%. And previous to this, it was close to 4.8%. So since Trump has come into office, since he has won the election, and since he's in the White House, U.S. bond yields, the borrowing cost for the U.S. government has been coming off. Although the Fed has not done anything at all, right? They have just been talking about not doing anything. In fact, all they have been doing is saying that they are not doing anything. And if you're observant, you'll see that prior to that, there was a big rise up heading into the elections, right? And there was the fear that if Trump wins, because the odds of Trump winning prior to elections was rising as time passes, and as it rose, the odds of Trump winning rose. The probability of him being in charge of U.S. policy drove U.S. bond yields higher, drove borrowing costs higher, because they thought, oh no, he's going to come in, he's going to spend a lot of money, he's going to borrow a lot of money, and just much like for governments as well as for normal people in this in the street, if you start to borrow a lot of money, the banks start to charge you a lot more money, charge a lot more interest rates, because your credit worthiness decreases every time you take on more loans, right? And what has happened since he won is that he has not demonstrated the fear. He has not fulfilled the fear of going excessively, spending a lot of money and imposing crazy amounts of tariffs. He still threatens to impose the tariffs, but he has not really done anything significant in terms of that, except getting better deals from Mexico, from Canada with his threats, right? So what has happened is that U.S. bond yields rose into the elections, and post the elections and post the Trump taking control of the White House, it has come off. So what we have seen is, it is as a reminder, the Fed probabilities has in fact come off. So there's less cuts projected, but interest rates for the US government in the longer maturities has been coming off. So that's important. So, and what does it mean? It means that it's not just about policy interest rate, which the central bank can control. It is also about the bond market, which is reliant on many factors. Some of them is, of course, demand and supply, and policy, government policies, and what are the likely outlook going forward, inflation. So a lot of things come into play here. So it's not just merely looking at the financial press and saying, oh, the Fed is not cutting interest rates. They don't want to cut interest rates. So the stock markets should be challenged. But actually, what has been happening in this environment of relentless reiteration that they do not intend to cut interest rates until something changes, we still see interest rates in the longer end going down because of the lack of trade tariffs being executed, as well as somehow more reasoned policies from the Trump administration. So moving from that to Trump, right? So what has Trump been doing since he came into office is that he has been announcing a lot of measures, and all these measures are essentially what he kind of promised during his campaign trail. And this is a bit novel, given that most politicians tend to forget what they promise on the campaign trail, or they take a long time to execute. But he has, in addition to the promises that he's made some really in normal political circles and in normal, I guess, even in everyday conversations, it seems kind of odd that he's threatening to take over Greenland. He wants Canada to become the 51st state. He wants to take over Gaza. He thinks it will be a great place, beautiful place, as he says. If US takes over, he redevelops it and send all the refugees to the other Arab nations. But and also something called the Department of Government Efficiency, which is run by Elon Musk, and cost cutting, aggressive cost cutting they're supposed to be doing. And also now we have recently seen that the US has engaged Russia without Europe and without participation from Ukraine to end the Ukraine war. So he has been doing a lot of things that may rub people the wrong way, seems very unconventional, but to reiterate, we are not here to discuss politics. I know Trump is a very polarizing figure. Some people hates what he does. Some people loves what he does, hates what he says, loves what he says. But that's irrelevant to finance, right? Irrelevant to making money. It doesn't matter what you think about him. What we need to think what we really need to think about is just what he says and what he does has an impact on markets. So we are here to interpret the effects of his impact on markets. And the key words that's been most impactful on market is tariffs, right? How has it been affecting the market? He's threatened tariffs on Canada and Mexico. Was supposed to be executed in a matter of days when he announced it, then delayed 30 days later at the last 30 days later at the last minute, because Canada and Mexico gave in to some of his demands, which is like controlling the border, controlling the flow of drugs into US, controlling of the flow of immigrants into the US. And he continues to threaten more tariffs on them if they don't execute. And the only tariffs he seems to have really executed is, of course, on China, and some reciprocal tariffs he's threatened to execute it, announced it this week, but there's really nothing concrete yet. Of course, he also increased tariffs on steel and aluminium, and all these tariffs that he proposed, some have been executed, some have not been executed. But those that have been executed is not as punitive or as drastic as feared when he was on a campaign trail and when he was coming in. And that's one of the reasons why inflation fears have been dropping a little bit, and the US bond markets has been doing really well, right? Interest rates have been falling. When interest rates fall, the prices of the bonds rise. So what's the result of the tariffs so far? What is the results of the tariffs if they were fully implemented, right? That's what were the fears of the market. The market was afraid, very fearful of these protectionist measures. They were fearful of US initiating tariffs that will cause a trade war. So they announced tariffs on China, China announced tariffs on US doesn't like it, they go back and forth. So there was a major fear. But what we've seen is that the reaction from China has been pretty sanguine. No escalation from Canada and Mexico. Initially, when they threatened it, Canada and Mexico says, "Oh yeah, if you slap tariffs on us, we'll slap tariffs on you." But of course, no one dares to pick a fight with the biggest bully in town, right? So in fact, they backed off. And so the fear was, if the trade war escalated, imports will be more expensive for US consumers, because it always, that's the fact of life. It's not the elephant. When the elephant fights, it's all the small animals in the vicinity that gets hurt. So consumers typically are the ones who have to bear the brunt of the higher cost, and that will have inflation to rise drastically. So of course, that has not yet come to pass. Maybe it may not, but the probabilities of that is dropping, and that's why interest rates are dropping as well. And when this was happening, risk sentiment took a hit, and that's why we see risk sentiment weakening every time that Trump announced something crazy or announced something that drastic. So what we have seen on the chart here, we can see that each time there's mention of tariffs that are new to what people are thinking, it caused a bit of a sell-off. But as you can see, the magnitude of the sell-off is dropping, right? Because the first instance when he announced it was very fearful, right? It's kind of like the boy who cried wolf, right? The first cry for help, everybody comes. The next cry, less people come, and after that, less and less people come. Of course, eventually, maybe the wolf may eventually turn out, as we know from the proverbial stories. But currently, that's how the market is reacting as well. More mention of tariffs that do not translate into drastic action, that just does not translate into high prices for that can be passed through to consumers. The reaction function diminishes each time the tariffs announcements come. But of course, don't become too complacent, because it is one thing for sure about the Trump administration is it's pretty unconventional, and it's pretty unpredictable. So what has happened is that although each of these announcements have coincided with sell-offs, it has all come back pretty soon after that, and each time the recovery becomes faster than before. So what does it mean, right? It means that it is just volatile, and we cannot be sure what's going to happen in the days before this. And the other thing that adds to the volatility of the market is, as I mentioned, tech and AI. What we have seen is that AI is a driver of markets since the launch, and it is a big initiative for the Trump administration that they want to launch the Stargate project, which is $500 billion project to build the infrastructure for AI in the US. And also another thing that has captured the imagination of the markets, but as well increased fear that AI is overvalued, is the emergence of AI from China called DeepSeek. And as we said, it's a big project participated by all the major companies of major tech companies that are in AI, and of course, friends of the administration as well, also SoftBank, and it's already underway. But when announced, there's positive news. So we saw a spike in NASDAQ, and then when DeepSeek, which is the open source rival for Western counterparts, was announced, it's very cheap. Suddenly everything's, oh no, it's so cheap, I can get it for so cheap, I don't need so much of these semiconductor chips. Maybe we are mispricing, we need to reprice our expectations of profits for US tech, right? So what has happened is when they announced this, there was a sell-off in US tech, and it was close to 4% on a Monday open, because DeepSeek announced over the weekend that they have figured out how to create a clone of OpenAI's ChatGPT for a fraction of the cost. So everybody didn't know what that means. It could mean that nobody needs to buy any more NVIDIA chips. Of course, that's very much overblown. But the first instant reaction is get out, right? But we have seen since on the hourly chart that it just took a matter of hours before the sell-off was negated. And even a deeper sell-off we saw was in NVIDIA, because it was the major chip producer for the AI industry, and it dropped more than 10%. And what does this all mean? This means that you have to ask yourself this: when something happens, is it really all that bad? But most of us we are not technical people. We're not well versed in what it all means. The first instant reaction is you want to get out, you want to panic. But that just means we live in a world where there's going to be more sell-offs, there's going to be more volatility, because of two factors that are, of course, the usual factors are always there, right? There's always the uncertainty with all the other players in the geopolitical world, but we have a major addition the next 4 years, especially this year as well. It's a Trump administration. Nobody knows how it's going to work in Trump 2.0, but so far his policies seem reasoned, although seems drastic as well on first announcement. It causes sell-off. And in the tech industry, it's much more than before that tech will contribute volatility, because AI is such a new thing that so many things can happen in the positive way as well as the negative way. But in the short term, there's going to be sell-offs, there's going to be volatility, and you cannot really plan for this sudden spurts of volatility except to know that this is now a feature of the market. So when I started off the presentation, I said the inevitable trend. It's not about what's going up or what's going down, but it's about the volatility is rising, it's likely to stay high. And it's not just volatility that bothers traders or investors, it is the randomness of it all, right? So it's either positive or negative, but we don't know what on any given day. So you sleep, go to bed, you're not really sure what's going to happen while you're sleeping. But even with this, we are seeing S&P and Nasdaq, the major stock indices in the US, hitting all-time highs all the time. In recent days, of course, yesterday was a big sell-off, and that was again on some random news that COVID is a new kind of virus, much like COVID is emerging out of China. That was one of the reasons why the markets was closing really weak into the sell-off, was really weak into the closing, selling off into the closing. And this is not updated for yesterday's move, but you're seeing that all this volatility, all these fears, negativity, but still we are seeing S&P rising to new highs. Right? Before yesterday's sell-off, it was at new highs, and of course, I think we may see a bit of a panic selling, but likely we'll see a new high again soon because conditions remain very benign. Interest rates in the longer end remain on the path downward, and Trump policies, although seemingly random, is a lot more reason than what it was before, and he has been getting good terms as well. So it's the same case with Nasdaq. So the market is uncertain. What is certain is that there will be extreme volatility. There will be tweets, policy announcements. Of course, for those who really follow this, it's not so much about tweets anymore. He's using his own social media platform, but eventually comes in to the Twitter platform as well. And we have news on the tech front, especially the AI front, which can cause a lot of volatility. And this part, as an aside, I think most people think, oh yeah, AI affects only tech, but eventually it will come to a stage where AI is so much implemented, so important to the supply chain, to the logistics world, to energy production and everything. It will be causing volatility in all sectors at some point, not so far into the future. But of course, that's another conversation. So how do you thrive in such an environment? You need to have risk reward ratios that are correct, meaning you need to have asymmetric outcomes. What does that mean? It means that you want to structure your portfolio such that when you lose, you're losing a finite amount of money that you're willing to part with. And that's inevitable part of investing and trading. There will be times that you're losing, but when you win, you want to be winning multiples of what you risk. So that's a very key feature in all trading strategies that are profitable. But of course, it is even more so now because of this extreme volatility. You don't know when your downside will be tested. So you need to size your trades appropriately. It was much easier in the past few years when it was just one way up. And now, although I think the trends remain, we still see a gradual rise, or in fact, volatile rise going forward, but we will see downsides being tested as well. So you need to know how to manage your worst case scenarios. And this is where a good trading system that has risk reward, asymmetric outcomes, ability to size appropriately matters, right? So what is asymmetric? I think is an uncommon word. You don't use it in everyday conversations, but it, as an example, it is something like Bitcoin, which we have been talking about for years now. It is important to have some parts of your portfolio where, of course, you have some people like the dividends, some people like the passive income, but you want to have a portion of your portfolio as allocated to asymmetric outcomes, meaning that when you're right, you can make multiples of what you put in, but when you're wrong, you just know exactly how much you have put in is likely to be lost in the process. So right now, clear clear asymmetric outcomes that can be had in the market is like Bitcoin. Even now, yes, I think although people think 100,000 is far away from the downside, but still you don't know where it's going to be in 5 years' time. And also tech stocks, mainly AI related tech stocks, right? So in conclusion, global macro conditions constantly change, and it's very hard to keep track of all these things, but you don't need to try to figure it out yourself. And financial press, although I call them financial entertainment because they tend to report to you after the fact, and they don't really tell you. In fact, I don't see much of the commentary saying that the policy, the interest rates in the longer end has been coming off relentlessly, although the Fed is on hold. So something like this is what we share with our community. So sign up for our distribution list. I'll give you the link in a bit, and we can interpret it for you. We also have trading courses which have strategies which is asymmetric and which has been doing quite well, especially in recent. It did more than 100% combined for last year, and start coming into this year, we are up 30%. So Richard is a strong supporter of that, a strong user of that strategy. So have a consideration. Come to our site, click, scan, join us, look for us, track record. And for now, thank you. I hope I've been sharing my views that is useful to you. I'm happy to take some questions now.
Thank you, V. All right, thanks for your sharing. And for those of you who have just joined us, please scan the QR code on the screen so that you can be kept posted of V's view on his mailing list as well as Telegram channel. The general views that V shares are free, so feel free to join his mailing list as well as his Telegram channel. And if you have questions for V, please type them into the chat box that you see on the screen right now. If you're on the computer, it will be on your bottom right. And if you're on a mobile device, it would be, you will need to scroll up or down to look for the chat box. So please type in your questions, if any. And meanwhile, V, I have a few questions,
Okay.
if I may ask.
Yes.
Yeah, to pick your brain, because I'm terrible at macro. Right, so I mainly make my decisions and interpretations from the charts. So since you're on the webinar, I'd like to pick your brain. Yeah.
Okay.
So
Sure.
with Trump 2.0, the way that I look at the market is that it's been jittery. It want to go up, but it's been jittery. So there's a lot of fear because we don't know the kind of aggressive policies that he can implement, and then how
Yes.
would the affected parties react, right?
Yes.
So he will use the way I see it is like K drama like that. So there are a few things that he have recently trying to resolve, which is one of them is Ukraine war, right?
Yes.
So the way that he has been, during his campaign, he's saying that he's going to end it in 24 hours.
Yes.
I don't know how he's going to do that, but apparently that is not the case. But certainly he's been making progress. That if he continue on this trajectory, it seems that the Ukraine war might end, right? So if
Yes.
the Ukraine war does end, what is your view about the US market? How do you think the US market will react to the news if the declaration comes that the Ukraine war is ending?
Okay. Uh, First of all, I have to address something that you said. You say you don't know much about global macro. I think it's not true. I think global macro conditions are also reflected in charts. And you actually pointed out something very, very interesting, which at the beginning you said your fear and greed index, right? You call it
Yes,
fear and greed, FGI, yes.
correct.
That's a global macro indicator, right? Because you take different indicators of fear and greed, and then you put it in, and then it shows you extreme fear, extreme negativity, extreme optimism. That to me is actually a way to look, one of the way to look at the world, right? It's great. It's so it's not that you don't know, you are looking at different representations of it, right? I so So to people on Wall Street, they're paid to explain it to people in complex terms, right? So you and I are doing it in simpler terms, hopefully. And I love the way that you describe the market as jittery. So my presentation could have just been, it's jittery, right? It's jittery, but it's going up. That's my presentation in 5 minutes, actually, right? It's actually, you describe it correctly. Your fear and your fear indicator and your jittery explains everything I've been saying. It's been going down, going down, going down. People are very fearful. But when you see extreme fear, it's actually not the time to join the fear, because the overall global macro conditions continue to support the market going up. And so that's my divergence. So I have to point out your humility in trying to say that you don't know, but you actually do know. But the Ukraine war is very interesting. So I think many people, many traders, they like to frame the war in okay, if this happens, then should I be betting on this outcome, right? So the better way to do this is to think, what are the inevitable outcomes? Meaning that regardless of whether it happens or not, whether the war ends or not, what happens, right? What happens really? So it's very interesting that you pointed out. He says, okay, I'm going to end the war in 24 hours. Of course, that's just superlatives. That's how he talk, right? Everything is either digital 1 or 0, right? But it cements what he's trying to do. He's going to be like, I'm ending the war no matter what you guys say, unless something happens. So what is it that he wants? So he pointed to two things, right? One is if you want the war to continue, basically he said to Europe, you have to pay for it, right? You have to pay more than you are paying now. And then he told Zelensky, right, the Ukraine leader, that if you want more money from us, you have to pay us in your mineral rights. So I'm going to take 50% of your mineral rights. If you don't want to pay, I'm not going to, if you don't give it to me, I'm not going to pay for your weapons. So now we are in a situation where he actually went ahead and have a discussion with Russia without Europe and without Ukraine. No one thought this was going to be possible. This seems like it makes no sense. How can he slight his allies like this, right? But he's openly having a feud with Zelensky, because it's very clear now. He says, if the war is to continue, you guys have to pay for it. I'm not going to pay for everything anymore. Makes sense. But if you don't want to pay for it, I can end the war with Russia myself, right? I just say, you are not going to join NATO. I am NATO. No one. The whole thing is all about whether Ukraine joins NATO or not. If that guarantee is given to Russia, it's likely that Russia will agree to a peace deal. And last night, I think there was this news that Russia may be willing to use the $300 billion that's been frozen to rebuild Ukraine if the war ends. And this basically means Russia is willing to pay for it, right? And when you say, oh, rebuilding Ukraine, it's likely going to be going to US companies, right? It's not going to be like, oh, yeah, Europe comes and rebuild Ukraine. It's not going to be Ukrainian companies building Ukraine. It's going to be small participation, but likely it's going to be US contractors. So what happens? Another thing that he talks about is low energy prices. So what happens if the war ends? It means Russia now enters the global oil markets again, right? So this is all pointing to whatever happens to the Ukraine war, US companies, US benefits. Either US companies, corporates benefits from rebuilding contracts, lower energy prices, mineral rights, or US government benefits from a lower deficit, meaning Europe has to pay more. US government takes control of mineral rights. They have a secure source of rare earths outside of China. So it's almost, as far as I can see, it's a win-win from here. So of course, on the first instance of a good news, the war ends, the market will rise. But if, say, the war continues, maybe the market's bearish or not, but I think everybody expects it to continue all the time anyway, right? It's been 3 years, right? It's supposed to be a 2-week war or 1-month war, but it's been 3 years. Nobody cares about it that much anymore. But essentially, what happens is that if it ends, we will have positive announcements to the upside. If it drags on, it just means that US will be getting better and better terms. So if the US government benefits with a lower deficit, we will see what we have been pointing out, that US interest rates in the longer maturities will continue to come off. So we will have conditions for higher stock markets, better outcomes for the risk assets, especially stock markets in the US.
Wow. Cool. Thanks, V, for that interpretation. Yeah. Um, now let me move on to the questions that some of the audience have posed. One of the
Okay.
question came from Ong, and Ong is asking about Ethereum because you mentioned
Okay.
Bitcoin, right? You didn't mention
Yeah.
Ethereum.
Every
So
time I mention Bitcoin, I will have someone asking about Ethereum. Okay, what does Ong want to know about Ethereum?
he said, is Ethereum finished?
I ask myself this question every day. Not every day, but when I look at it, I also ask myself this question. I think this is a very difficult question to answer. It used to be I was a very strong proponent of smart contracts and all, but the alternatives of Ethereum has been coming fast and furious. But I think one thing that is going for Ethereum is also that it has an ETF, right? Something that has an ETF will always have an audience in the general population of investors. But uh, the question, is it finished or is not finished? I think it's very hard to answer. You have to, and I myself don't have an answer for this. I think uh, the better part, if you're just going to be invested in crypto, you're not thinking about what are the likely outcomes going forward in terms of Ethereum as an for executing smart contracts and all. The Bitcoin is a much better proposition. Although yes, it's a sticker shock. It's 100,000, right? Everybody thinks like this, but I think in the generation that is to come, people that is to come, they're not thinking in terms of trying to buy one Bitcoin. They're thinking of trying to buy a fraction of a Bitcoin, right? So I think in our lifetimes, this will be the only time still that it's possible for people to buy one Bitcoin, right? Everyday person, it's possible still. If you scrape enough for your savings, it's possible still to get fraction like half a Bitcoin or whatever. But I think it's much better to be invested in something that's very inevitable than there's quite a bit of a downside in thinking. Although I still am invested as well. I think it's not quite yet finished. I think we still have hope, but it does look very disappointing. The price action, right? It goes up, then suddenly it comes off. It sells off a lot more than others. Uh, yeah, we are on the same boat. Very disappointed, but holding on to this possibility. But it has to be a portion, as I said, that you're willing to forego. It's okay. You're allocating a part of your assets to something that could be obsolete. I don't think it's going to be obsolete, but it could be. There's a risk, and the risk is higher than before. But when it goes right, it continues to go right. It gets adopted by mainstream companies to execute their smart contracts and all. It could be asymmetric to the upside.
Right. Thank you, V. And Ong, I hope that answers your question. So I think from what I hear from V, Bitcoin might be a better choice if you have not already invested. Okay, now the last question would be a few of the attendees are asking on your views on gold.
Okay. Interesting. Gold has been under the radar for some time, but it continues to go out, right? So I think gold is very is behaving quite strangely in that it goes up, actually is almost close to all-time highs, and you don't see that much press about it compared to before, right? Usually somehow it's become a forgotten thing. And it's based on charts, based on how it's behaved. Yes, it should the trend is very strong, it's likely to continue. And it seems also asymmetric to the upside in that there's kind of like news that the Bank of England is defaulting on delivering gold, physical gold. So that's something that could be what we are seeing, that they are finding difficulty logistics to deliver gold, and that's why we are seeing gold continue to rise. I don't have a good explanation for why it continues to go higher, although global tensions are easing, right? We are seeing likely the probabilities of resolution in Ukraine, Russia is rising. The probabilities of resolving the Gaza, the Israel war is rising as well. And theoretically, that should cause gold prices to come up. But I think we are not seeing that, right? We are not seeing that. So in when things cannot be explained, there must be some other things that we are not seeing, right? And I have yet to see a good explanation as to why. And that's usually why uh, that's usually when it's likely to continue, because most people, it's not obvious that you should be long gold by, because there's no obvious reasons, but it continues to do well. So I think what has been working should continue to work. You should buy. I mean, not you should. I'm not supposed to give advice. I would be buying gold on dips myself. Yes.
Right. Thank you very much, V, for your answer. I hope for the few attendees who asked about gold, the answer is insightful for you. Okay, V, thank you very much for your time. And any last words that you'd like to share with our attendees?
No, thank you. Thank you. Sorry for the delay at the beginning, but it's good to have the opportunity to speak to your audience. Thanks, Richard. Thank you for sharing your index as well. It's been useful to me as well. Okay, that's it. If there's no more questions, if you have other questions, feel free to reach out to us through Richard or through the QR code here, and sign up to our list. We try to demystify the markets in plain language, and hopefully we'll see more of each other in the year ahead. Good night and good luck.
Yes, thank you, V. And for
Bye
those who
bye.
just attended, please scan the QR code and join V's Telegram channel or mailing list, where he share his macro views almost every day, and that's free. All right. So thank you, V.
Yeah. Thank you. Bye bye.
I'll stop your sharing now.
Yeah.
Okay, and now let's come back to the agenda. And thank you, V, for your insightful sharing. You can also disable your screen and also mute yourself. Okay, and now we move on to our second speaker for the day, Mr. Kenny Low, who is a REITs expert, my REITs Sifu, as well as he is now also a licensed advisor. So whenever we talk about, whenever you're in doubt, please seek professional help. Well, he is one such person that you can reach out to. Okay, Kenny, hand over the stage to you. I can see you.
Okay, can you see me? Can you hear me? Can you see my
Yes,
slide?
I can hear you. Your slides is still waiting, so let's wait for a bit more.
Right.
Okay, I'll play some elevator music in the meantime. Okay, I
Yeah, you
do
left.
see it now. Your slide is on the screen now. Take it
Oh,
away.
okay. Yeah, I'll go and take over. Thank you, Richard. Good evening to everyone. Okay, my now my session is more on the Singapore REITs market outlook. So, about myself, I am the Wealth Advisory Director and also risk specialist on the of one of the independent financial advisor in Singapore. I specialize in retirement planning and also the estate planning. At the same time, I am also the part-time trainer for SGX Academy. Every month, will be on the Money FM 89.3 to talk about the Singapore REIT market update. So if you want to follow closely on the REIT movement in Singapore, you can just Google search on the Money FM, Kenny Law. You should be able to find my previous interview for the past 5 years. Okay, I have my one of the website. Okay, REIT Savvy. I'm the founder of this website. So if you want to find any REIT information and also have a REIT screener to help your investment decision, you can go to REIT Savvy to take a look. Right. The usual disclaimer. I There are some of the REIT information and also the sharing of some of the REIT valuation and also the dividend yield in this presentation. But do take note, those are not a recommendation to buy or sell, no matter how attractive the valuation or price. Okay, today agenda. I will go through the 2024, the whole REIT sector performance. And after that, I will touch on 2025, the REIT market outlook, right? Then I will end the presentation with some key takeaway and also investment strategy for the REIT in 2025. Okay, review of 2024 performance. Right, so S-REIT basically underperformed the STI for the whole year in 2024. You can see from this chart itself, on the red line represent the STI index. Okay, so STI has grown about 18% for the whole 2024. For the financial sector, mainly driven by the top three banks in Singapore, have a total return based on the price itself of a 35% in 2024, but basically in the REIT itself is really muted, okay, -9% throughout the whole year. So 2024, in short, is underperforming a year for the whole REIT sector. Okay, and 2024 basically is quite a roller coaster year for S-REIT. You can see that actually they are trading a sideways, halfway range bound. It's very good for trading, but it's not good for those investor, or especially on the retail investor who don't really understand the REIT asset class well. It's very difficult for them to really ride through the year. Okay, basically you can see that whenever you buy at the maybe high point, you probably will suffer paper loss of -15% throughout the whole year. Then after a while, you will rebound back strongly again. Okay, basically we are seeing the range bound trading range on a FTSE REIT index between 620 to 730 point. Okay, so 2024 is a test of an investor conviction in the S-REIT investing. If you encounter this volatility and you don't feel really comfortable, I strongly suggest that investor really look back into your portfolio itself and also try to understand S-REIT as an asset class before you move forward. Because otherwise, moving forward, you may feel very uncomfortable if the interest rate continue to stay high and continue to be volatile in 2025. Okay, so what caused the sell-off in Singapore in Q4? Okay, basically, just look at this chart itself. Singapore sector actually start to rally quite strongly in the Q3 of the 2024. Then when you come to the Q4, actually there was a sharp sell-off, right? Actually, what caused the sharp sell-off? Okay, in short, is the rally of 10-year US government bond yield. Just now, we already touched a little bit on the interest rate direction and what Trump is going to do, and also the US 10 years risk-free rate. Okay, basically, you can see that actually during that time, actually, there was a sharp rally since September 2024 on after the 10-year risk-free rate hitting a 3.6%, and after that rally back to the 4.6%. There was a very strong rally on the US 10-year risk-free rate. And this mainly caused by the Trump 2.0 inflationary policy. I'm not going to touch on what Trump do and whatever thing do. It's just a summary is after the Trump won the election and control the Senate and also the House, and doing all sort of the instruction and also order, the market actually fear of the return of inflation, right? That caused the spike in the 10-year risk-free rate. And this 10-year risk-free rate has very strong correlation with Singapore rate. Okay, since 2023, you can see clearly that on this chart there is an overlay of US 10-year risk-free rate, which indicated in the red color. Okay, red color. This is a 10-year risk-free rate, and the S-REIT FTSE ST REIT index is represented by this blue line. Okay. Whenever there is a spike, that there was a rally on the 10-year risk-free rate, there will be the correction of the FTSE ST REIT index. Okay, same thing here. When the 10-year risk-free rate coming down, the FTSE REIT index will be going up, right? So on and so forth. Very strong correlation. And this is not really only Singapore REIT itself. It applies to the whole Asia's REIT sector. Okay, this chart actually from the Manulife Asset Management. They're managing the REIT fund. You can see clearly here, 10-year treasury yield risk-free rate. Okay, when it's coming down, the whole Asia REIT fund going up. Okay, so on and so forth. So the inverse correlation is very, very strong for Singapore REIT sector and also the Asia Pac REIT sector. And we are not alone. US REIT sector also showed a similar pattern. And you can see from here, when the risk-free are represented by the red color, when it goes up, okay, the US REIT ETF, they are pretty muted. When it comes down, the REIT ETF actually is going up. So this is the whole sector phenomenon and the inverse correlation between the REIT index globally and also the US 10-year risk-free rate. Okay, and in terms of 2024, how was the Singapore REIT individual REIT performing? Okay, I'll come to this my analysis on my website. Okay, in short, total 38 S-REIT in Singapore registered a total return of negative 3.57. This is a total return. Total return means that you add all the price information plus all the dividend received. All right. So in the blue color itself, blue color is a dividend. In January 2024, the whole REIT sector, the average is about 5.7% dividend. But in terms of the capital gain or loss, they registered minus 9%. So all in all, the net return for the whole S-REIT actually minus 3.57. Okay, this is the whole S-REIT. The top three more resilient sector would be the specialized sector, register a total return of 6.9%, whereby 6.1% is purely from a dividend. The price actually just very small 0.86%, and followed by the second sector would be the healthcare sector. Total sector return 6.46%, and dividend yield itself is 7.26. All right, although negative, there's a negative price action or price changes for the whole this healthcare sector. And the third most resilient sector would be the retail sector. Total return 3.1%, the dividend yield 5.3%, and also suffer the capital gain, capital loss of about 2.28%. Right. The rest of the sector, for example, hospitality sector, industrial sector, office sector, they are registered a total negative return. Okay. So this is a sector, right? If you want to come to the individual rate, you can go to this blog post itself. This analysis will show all the whole year capital gain or losses, and plus all the dividend, and also show the total return for each of the 38 REITs in Singapore. So this is a snapshot on the S-REIT performance in 2024 itself. Okay, I'm not going through all the detail. You can go to the blog post and take a look. All right. So moving forward, what would be the 2025 US interest rate outlook and also the impact of the REIT itself? This is the latest FOMC dot plot. Original plan that actually the interest rate supposed to come down even further in 2025, but based on due to the inflation fear by the Trump 2.0 policy, the latest revised dot plot would be is expected the interest rate probably you register only 25 basis point cut in 2025. So that is a pause in terms of the rate cut. Actually, that caused the whole REIT sector muted. Okay, if you look at the CME group, the Fed future meeting probability itself, right? At the present moment, we are in this band, 4.25 to 4.5 range. We don't expect any rate cut for the first half of the year. There will be only 83.6% 25 basis point cut by end of the year. All right, by end of the year. So it's pretty muted, and that actually paused the excitement to the whole REIT sector itself, because all the investor is expecting the inflation is coming down, the Fed will go through the aggressive rate cut, but unlikely it's going to happen in 2025. And even in 2026, we also not seeing that there will be a very drastic or huge rate cut moving forward. Okay, by the way, all this number will change every day. All right, if the inflation number keep coming down, if Trump continue to push for lower rate to really boost out the business sector, because at the end of the day, we need to know that Trump is still a businessman. Businessmen don't like high interest rate. He want low interest rate for the business to thrive. Okay, so nobody know what is going to happen in the future, but do take note that the pause in the interest rate cut actually does not serve very well to the whole REIT sector. Okay, now I will do some very brief revision on what would be the REIT business model, because I want to explain to everyone how the interest rate cut would benefit the REIT moving forward if that there is a anticipated rate cut moving forward. Okay, so basically REIT, there are two forms of fundraising. They are either borrow the money from a bank or creditor or the investor to generate the fund. Then after that, they go and buy the real estate or property, depend on which sector on the depends on the investment mandate. They can buy the commercial property, they can buy the factory, warehouse, or a hospital, nursing home. Okay, depends on what kind of mandate. After purchase of real estate property, they will generate rental income. The rental income, after paying off the interest rate payment, the 90% of taxable income has to pay to the investor as a dividend payout. All right. So I will show this, I'll go through this one slowly so that everybody can understand what would be the interest rate impact on the financial ratio. Some of the key financial ratio will be impacted by the rate cut moving forward. Okay, when interest rate coming down, that will help to the interest expense to drop. When the interest expense drop, the interest coverage ratio will goes up. But do take note that this very much depends on the debt maturity profile, right? Because it's not necessary that when interest rate comes down, all the REIT will be benefited from the interest rate cut. Okay, it's very much depends on debt maturity profile. Later, I will explain what is this all about if you are still very new to this financial ratio definition. Okay, and with the rate cut, that will help to reduce the cap rate. Cap rate is one of the numbers used in the property valuation. When the cap rate comes down, the property valuation goes up. That will help the gearing to come down. When the gearing ratio coming down, that will help in the credit risk. The credit rating goes up because of credit risk coming down, and overall, there is a positive effect on the funding cost. When the funding cost is coming down, that will help the REIT. Okay, I assume there's no change in the rental income, operating expense, lease expiry profile, rental reversion, and also occupancy rate remain status quo. So all in all, if the interest rate coming down, that will help the REIT to have a higher distribution because the funding cost will be coming down, and at the same time, all right, and all the interest cover ratio will be improving. The risk of the REIT will be reduced. That will give a higher confidence or commission for the institution money or fund manager to rotate back their money into the REIT sector itself. But do take note, there is a time lag of the interest rate impact on the DPO, distribution per unit, and also the net asset value. Okay, why is there a time lag? Okay, I will show you two different debt maturity profile by two different REIT. Okay, the first one is the debt maturity profile by Elite UK REIT. You can see from here that there is no debt to be refinanced in 2025 and 2026. Okay, what does it mean? It means that whatever changes in the interest rate in the market, okay, that will not have any impact from this REIT because they do not need to refinance and they don't have even have an opportunity to refinance at a lower rate. Okay, but if you look at the OUE REIT, the debt maturity profile, there's a big bulk of the debt to be refinanced in 2026. If they are able to refinance this debt in 2026 to the lower interest rate, basically this REIT will enjoy from the rate cut moving forward. Okay, so debt maturity profile is very, very important while analyzing whether the REIT can benefit from interest rate cut and also have a boost in a dividend moving forward. Okay, so where to get all this information? All right, my REIT screener have all this information. All this financial ratio can be sorted. Okay, let's take a look at which REITs has the lowest debt maturity profile. Okay, EC World has the lowest debt maturity profile, but EC World has been suspended, so we just exclude this EC World from this explanation. Okay, the next one would be the Daiwa House Logistics Trust. They have a debt maturity profile is 1.7 year, but if you look at the fixed rate itself, they have a 99.2% of fixed rate, and also majority of the debt they are in the Japanese yen. Their interest cost is also pretty low, 1.1%. So this Daiwa House Logistics Trust will not be benefit a lot from the US rate cut. Okay, do take note, they are borrowing the money in Japanese yen. All right, so not really impacted. The next one would be the Paragon REIT, 1.8 years, 70% of fixed rate, and the interest cost is 4.4%. Okay, so Paragon REIT probably will benefit from the rate cut moving forward if they have the debt to be refinanced within this 1 or 2 years. So this is how you can combine the financial ratio and also analyze what would be the impact of the rate itself. If you're not really familiar or find that the number is too difficult to really visualize what is going on, okay, there is another chart to give you an overview for the whole REIT sector itself, which are the REIT have a very high fixed rate comparatively, and also the debt maturity profile. All right. So this is a snapshot of all the 38 REITs represent in the bubble chart. Okay. So the bubble size represent the market cap. Okay. And on the y-axis itself, will be the debt maturity by years. So for those REIT which have the lower debt maturity profile will probably benefited from a rate cut, but also very much depends on how many percent of their debt are on a floating rate or a fixed rate. The higher the fixed rate means that they don't really have chance to really refinance without the penalty. But for those REIT which have a lower fixed percentage of fixed rate, you enjoy a rate cut. All right. So combining all these factors, we want the debt maturity profile to be low, and also low fixed percentage of fixed rate. Okay, that will be the EC World, but EC World suspended. That's why we should not consider this one. The next one would be this three REIT, would be BHG Retail REIT, CDL Hospitality Trust, and also the Agrofed Hospitality Trust. All right. So investor, you can use this bubble chart to really do some comparison to identify which REIT would have a potential a boost in a DPU moving forward because they are able to enjoy the rate cut. Okay. But if you want to compare to the sector itself, okay, for example, if you want to compare which REIT has the best or you benefit the most from a rate cut for the diversified sector, right? These are the sector. Okay. So you have Suntech REIT, Fraser Logistic Commercial Trust, CapitaLand Integrated Commercial Trust, Maple Tree Pan Asia here. You can do the comparison for this diversified sector. If you want to do the comparison of the retail sector here, you can go through the filter retail sector, and all these are the retail REIT in Singapore, listed on Singapore Exchange, BHG Retail REIT, Fraser Centrepoint Trust, Paragon REIT, United Hemisphere, Star Hill Global REIT, and Cecil REIT, okay? And plus this Lipo Mall Indonesia Retail Trust. All right. So you can use this so-called filter to do your own analysis. Okay, I've gone through this one. Okay, so what would be the Singapore REIT 2025 market outlook? Currently, the FTSE REIT index is trading at a huge account. All right, I just go through this 5-year chart. At this low point due to the March 2020 COVID crash, right? Before the COVID crash, the whole REIT index was trading at a PNAV of 1.1. During the crash, the PNAV is 0.8, right? At the present moment, we are close to the 5-year low, okay, due to the interest rate and environment. And the PNAV of the whole REIT sector itself is about 0.88. Okay, let's look at the historical average. Historically, the REIT sector is trading at a PNF of 1.1, right? Before COVID, 1.1, after the COVID strong rebound, and also average in the 1.1. Assuming we are able to go back to mean, is a mean reversion, right? That would represent 22% to the historical PNF based on current valuation itself, and also 6.1% annual dividend yield. Okay, at the present moment, they are trading at close to the 5-year low. You just imagine if you plan to enter the REIT at the current valuation, while waiting for the mean reversion back to the normal, you should be able to enjoy around 6% dividend year over year. All right, so that represent a very good, interesting entry point at the present moment. Okay, and REIT index is currently trading really near to the very strong support. This support level has tested close to 5 times. All right, as if you base on the reward risk ratio itself, unlikely, but there is also a possibility, unlikely, the REIT will go even lower because of the valuation purpose. But we need to really look at the US 10-year risk-free rate. Later, I'll touch on the US 10-year risk-free rate to see what will be direction. Okay, so in short, the REIT index now is trading close to very strong support. Okay, we will see whether in the next 1 or 2 weeks whether this strong support can be held. Okay, so what is the latest US 10-year risk-free rate now? Okay, I took this number this morning. All right, so the current risk-free rate it is trading at around 4.4 something percent. There was a drop in last night trading. If you compare to the historical high, okay, it looks like the the US 10-year risk rate has peaked, and they are currently forming a head and shoulder pattern. All right, the uptrend support line has been broken and retested and rejected, and this line become the support turn resistant. At the same time, there is a very important level for us to pay attention to, right? This support level for the US 10-year risk rate is this. If this support line or neckline be broken, right, very likely there will be reversal, right? There will be reversal of the US 10-year risk rate, and it may come down even further. That will help the REIT sector, right? Do take note that because of the strong inverse correlation of the US 10 years versus the REIT sector. Okay, now let's look at the individual investor. What currently we can invest now with all the short-term interest rate. All right, so the current 1-year T-bill for Singapore is 2.78%. SSP is 2.97%. 12-month fixed D deposit at 2.45% offered by DBS, but only for those deposit less than 20,000. Okay, only 2.45, and CPF OA 2.5%. The inflation published by the Singapore statistics is 2.5%. So no matter how whatever money we are parking in the T-bill or SSB now, we just need to make sure that it actually can beat the full inflation. But do take note that moving forward, the T-bill and also SSB, even the fixed D rate will be coming down based on the projection. How low can it go? We do not know, but we know that the direction is, as long as there is the inflation does not coming back, and MAS probably will loosen the monetary policy and let the interest rate to come down. Okay, so you can see very clearly that 1-year T-bill it started to come down. It's a very clear downtrend. So we do not know how low it can fall. But investor, if you are maturing a T-bill or maturing a Singapore saving bond, probably you need to plan for your next deployment when the maturity comes. Okay, and at the present moment, there are number of REIT are trading the 5-year low. Okay, I come into this REIT screener again. Okay, you sort by the PNF 5-year low. Even the Maple Tree Pan Asia Commercial Trust, which own the Vivo City or also Maple Tree Business City, the PNF actually at the 5-year low, right? Even the Maple Tree Logistics, okay, all these REIT are Temasek related, right? Owned by the Maple Tree Investment. They are trading at 5-year low. Mapletree Industrial Trust also trading at 5-year low. If you look at the historical price to book for the Mapletree Industry itself, okay, you probably can see some very interesting observation. Okay, this is the historical distribution per unit. All right, as an investor, we always look for a REIT which have a growth in the DPO year over year and quarter over quarter. If you look at it over the long term itself, Mapletree Industrial Trust actually showing a very good growth in the DPO trend. Okay, so as a landlord, of course, you want to have a increasing rental year over year. So they are really meeting the objective, right? But unfortunately, right, based on the chart itself, Mapletree Industrial Trust, basically they are trading close to 5-year low. And if you look at the price to book itself, they are trading below the one standard deviation of a 5-year historical price to book average. Right. So in other words, basically, Mapletree Industrial Trust are current trading below the historical valuation and yielding about 6.8%, which is pretty attractive, and the gearing at 39.8% versus the gearing limit MAS set of 50%, right? But in terms of price performance, basically, MIT, they are trading on a downtrend. So it's up to the investor to decide whether it's a good entry point based on the valuation or based on technical analysis, right? Over the long term, the NAV is climbing out, but although recently the NAV is coming down due to the portfolio valuation itself, right? Because under the high interest rate environment, the cap rate to be used in the portfolio valuation is increasing. That will cause a portfolio value to drop. Okay, come back to this slide again, right? So in all, okay, I'll show the gearing ratio. There's another interesting thing itself, all right? Just give an overview of the yield for the whole REIT sector itself. Okay, at the present moment, most of the REIT, like just now I show in the table itself, most of REIT, they are trading below the valuation. The sector which is the most undervalued at the present moment would be the office sector. You can see that most of the office sector, they are trading below the book value of 1 over here. Elite UK REIT, the price to book is 0.756. And the even Keppel REIT, which own a grade A office in the CBD area, only trading at book value or price to book of 0.6, okay, which is pretty undervalued. Of course, with all the US REIT, they are currently in trouble now, right? So in terms of the valuation, the office sector is the most undervalued sector at the present moment, right? The sector which are performing well would be the healthcare sector and also a specialized sector. Specialized sector means that the data center sector. So in terms of data center, Keppel DC REIT are trading at the yield of 4.3% and the price to book of 1.41 times. And the Digital Core REIT is another data center REIT trading at the price to book of 0.6 and yielding at about 7%, which is also very attractive. In terms of the healthcare sector, Parkway Life trading at the price to book of 1.6 times, yield 3.77, and First REIT price to book 0.9 times and also yield 8.58 times. Okay, so in terms of the gearing ratio itself, the most of the REIT, they are pretty healthy, okay, below the 50% gearing ratio limit, except the Easy World and also the Manulife REIT, right? The rest of the REIT, they are basically is pretty healthy. All right. So if you want to get all the chart, those are the free information based on a bubble chart. They are free. Okay, only the REIT screener needs subscription for you to get those individual information for the REIT itself. Right, you can scan this QR code to access the information I just presented just now. Okay, key takes away. So on 2025 market outlook, interest rate has peaked, and the US Fed has cut 100%, 100 basis point interest since Q3 2024. Do take note that this impact has not been felt in the whole REIT sector itself because there is the delay effect. So I'm expecting either in Q2 or Q3 earnings, the REIT will start to release some of the we may see some surprise increase in DPU due to the interest rate cut impact. So do keep and watch out of the earnings result. So far the earnings has been released from the whole REIT sector itself. At least that I don't see a drastic drop in the DPO. Everything seems to stabilize. So the next quarter to watch out for is to see that whether the REIT benefited from the interest rate cut. Okay, so that will create a bullish sentiment for the REIT sector. All right, so the DPO would probably be boosted due to the reduction of interest expense moving forward, but not now. Now we still don't feel it, so it's very much depends on the individual itself and also depends on their debt maturity profile. The rotation may go back to the U asset class under the low interest rate environment. It depends on how low it can go. But if the maturing T-bill or T-bill, the interest rate continue to come down, SSP continue to come down, probably the investor may want to rotate out from a T-bill or SSP to look for some high yielding asset class, right? All in all, the average yield for Singapore REIT is about 6%. Okay, but in terms of the whole range itself, it range between 4 to 10%. And currently, the Singapore REIT sector are trading at a huge discount, which is a bull. REIT sector historically outperform other asset class under the rate cut environment, right? Bull. This is a good time for investor to lock in a high yield at discounted share price. And the chart itself has shown we are trading near to the bottom and also at a very strong support. The risk. The only risk would be the return of inflation and US Federal Reserve start to increase the interest rate. So this is one of the very, very important element I'm watching closely to see whether the US Fed go and increase the interest rate again, right? So that is a risk that investors have to pay attention to. Good. So what should we do in the 2025? What are the S3 investment strategy? Right, there are a lot of market noise and a lot of things to monitor in the whole market itself. So I would advise the investor to really focus on investment objective, because at the end of the day, investing in REIT is to focus on a passive income generation. It's not for the capital gain. Is you don't trade REIT for 30% gain in 1 year, because it's not going to happen that way. All right, at the end of the day, REIT is the underlining of a REIT is a real estate, right? So determine how much passive income or cash flow do you want for your dividend portfolio, right? Once you determine how much passive income you need then you just need to calculate what would be a portfolio size to really achieve your passive income objective, and buy when the REIT are selling at a discount, right? For example, if you want to invest in the real estate, you want to buy the property when they are cheap, and buy near the support level to optimize the reward risk ratio. And do take note that don't overanalyze until you're paralyzed, because really no one really can predict the stock market anyway, especially with Trump now. The market can be very volatile and also very, very much news driven. If you are really investing based on the news itself, you really your investment strategy will go haywire. Okay, very, very importantly, implement a portfolio risk management through diversification strategy. Do take note that S-REIT is still considered the real estate sector, which is very much sensitive to the interest rate environment. So when you design a portfolio, don't put everything under the same basket into the REIT sector itself. It's very, very important to have a proper asset class diversification, sector diversification, and also use a time diversification to manage your risk, right? And be greedy when others are fearful, and just ignore the market noise and focus on your strategy. All right. So my my summary is at the present moment, based on the valuation itself, based on the macro environment, and also the interest rate direction, this is a good time to start building your S-REIT portfolio if you have not done so. Don't put everything into one or two REIT, right? My advice is identify different sector, the top 3 REIT into the different sector, and just wait for the right time and also right price to start to enter, right? In terms, you just need to do some allocation to each sector itself, right? On all, you should be able to build a REIT portfolio with a weighted average DPO yield about 6.6% at the present moment. Okay, if you want to follow me on some of the REIT update and some other investing related information, especially come to retirement, you can go and join my Telegram channel. All right. So if you want to contact me, this is my contact profile. This is my profile. You can find my contact number over there. If you need any help in terms of the REIT portfolio advisory or management or investment planning, right? You want to understand, want to have a US stock portfolio or Singapore stock portfolio, or even want to have some recommended ETF or unit trust to invest, okay, I can help you to do the holistic and investment planning according to your objective. I'm also offering the private wealth solution. This is not our traditional stocks, bond, ETF, that kind of investment traded in the secondary. This is more on the private market. It's more on the private place, whereby I'm able to recommend the private equity, private credit, hedge fund, digital fund, forex fund, pre-IPO, private share, trade financing, private REIT, to diversify your portfolio from the market risk, right? Because when we are trading in the stock market, trading in the ETF, basically we are subject to the price movement. In terms of the private market itself, the private market basically they are doing own thing because there's no secondary market pricing there. That's why it's very important to really have a non-market correlated that kind of investment into your portfolio. Currently, I am advising my client to allocate some of the asset class into this ordinary investment place. All right. If you need to have a review of a life insurance policy, right? You're buying a lot of insurance, but you don't know which one needed or which one don't needed, right? We can go into the portfolio audit so that you can save some insurance premium if you don't need those insurance, right? And also offer the estate and also legacy planning, business succession planning in my advisory work, right? So this is my contact email and also my QR code. All right. That's all for my session. Okay, I hand over back to you, Richard.
Thank you, Kenny. Wow, what a lot of information that you have shared. But one thing I really like about Kenny sharing is that he makes things very simple and to the point and visual. So and also before I forget, I want to remind everyone that whenever we have a disclaimer, we talk about whenever you're in doubt, please seek professional help. Well, Kenny is certainly one such person that is licensed by MAS to do so. Right? So if you are too busy, too lazy, or really cannot figure it out yourself, you want professional help, licensed advisor help, then please feel free to reach out to Kenny. Okay, he is definitely qualified to do that. He's my REIT Sifu, and the foundation of my REIT investment came from him. So thank you, Kenny.
Thank you.
Right. Okay, so if you have any questions for Kenny, please type into the chat box at the bottom right of the screen. Kenny, you can leave this page there. All right. And then if you're on a mobile device, then you can type your questions into the chat box, but you will need to scroll up or down to look for the chat box. So while we await any questions that's coming in from the audience, Kenny, I have a few questions for you. All right.
Yeah.
So I really like your TA on the US 10-year chart, and I think that gives a very a visual, and for me who likes TA kind of a person, an idea, especially when to bottom fish for REITs. Right, you have the TA with the on the 10-year REIT chart, 10-year interest rate.
Okay.
Ah,
This one, right?
yes. Okay, yeah. Let's take a look at that. Right. So now, as you know, when was the best time to buy the Singapore bank stocks? Because one of some of the questions that I saw is asking whether it is a good time to buy bank stock now instead of REITs, So I actually beg to differ lah, because 2 years ago when there was a bank crisis, which is not Singapore bank but the Credit Suisse bank crisis, right? And then the US bank that failed crisis, that was one of the best time to buy Singapore banks. And the
Yes.
and the previous best time to buy Singapore banks is during COVID, right? So why? Because there was blood on the street for the banks lah, right? So if we recall what Warren Buffett says, right, when there's blood on the street is when you go bargain hunting. So now, because the rate was supposed to come down, and it did come down, so there was a bit of a REIT rally, right, Kenny, last year? But it fizzled off because this rate came down and then went back up again, right? Because it became higher for longer. So REIT kena again, kena whack again. But he gave us a very good glimpse of what will happen when the interest rate drops, when the US interest rate drops. The REIT will, I cannot use definite, but very likely it will recover. So now is a pretty good time to do some bargain shopping for REITs, right? So, so in your opinion, what would be your favorite REIT sector?
Okay, so interestingly, okay, maybe I show this one because most of the people want to focus on those big cap REIT, right? And also domestic link REIT. Okay, I show you this table itself, right? Interestingly, last year actually was a very bad year for those big cap REIT. Okay, if you look at those top 10 highest total return rate itself, you hardly see those Maple Tree Capital Land names there, right? If you're holding a lot of big cap REIT, Capital Land related REIT, Maple Tree related, basically you are seeing a lot red color in your portfolio. I think that most of us holding a big allocation in those big cap REIT. So my view is why the big cap has a huge sell off last year and also even performed badly compared to those small cap. Do take note that in the index itself, those big cap normally they are included in the index and based on the market cap itself. When the big institution they want to exit the REIT sector itself, they may be following index that also maybe they sell off from ETF itself. Then ETF have to offload those big cap according to their ratio. So that can be one of the reason. So okay, currently I'm buying REIT every month, okay, consistently due to the valuation itself and also the attractive yield. I don't have any preference in terms of my accumulation now because as long as technically at the bottom and at the same time they have at a very attractive valuation, I start to accumulate. It can be the those big cap REIT and it can be the small cap REIT. All right, big cap REIT we just need to take note that and if the big institutional don't come back into the S-REIT sector itself, you'll be continue to be depressed. If a big institute come back again, the big cap REIT we will start the first one start to move. All right. So in terms of volatility, at the present moment, the big cap surprisingly is much more volatile than a small cap REIT. Right. So Richard, you asked me any preference. Actually, I don't have a preference as long as they meet my investment objective and also clear my selection criteria. As long as they give me entry opportunity, I start to enter. But of course, I always need to limit based on my overall strategy, based on the sector allocation, because I don't want to have put concentration risk into the specific sector.
Right. So you're referring to the specific REIT sector lah.
Yeah, specific REIT sector. Because if you know that before COVID, industrial sector was performing quite badly, right? During COVID, the hospitality sector hit badly. But immediately after the COVID, in second half of 2020 and also first 2021, the industrial sector and also data center performed very well, right? If you can remember, Then where come in, I think 2022, the data center hit very badly. Now data center come back to life again, their best performer. And in 2022 and also 2023, the US commercial sector hit very badly. So there is also the sector rotation within the REIT sector itself. So if an investor do not really want to bother or don't have time to really watch all this kind of sector rotation, it's better to build a very diversified a portfolio with different sector into the portfolio, so that you don't really need to really going switching in and switching out.
I see, I see. Okay, great. Understand. Thank you, thank you. Okay, now to the question that some of the attendees is asking. One attendee is asking, John is asking for your view on, let's say this MIT, because 4 overseas properties that have tenants have confirmed not renewing the leases. So will it have an impact on the DPU? Also, I would say think JP Morgan have downgraded MIT price. What's your view on MIT's moving forward?
Okay, personally, I feel that those are noise. All right. If anyone still can remember, at one time, some report actually downgrade to say that data center rate is gone, right? Actually, that year data center rate actually doing quite badly. Then after that, data center now is the best performer. Uh, Tenant renew and tenant basically come and go, right? It depends on whether you want to report or don't want to report on it, right? It's part of a puzzle of the landlord business. You have lease renewal, you have tenant bankrupt. It's very much depends on whether you want to report those news or not, right? After the tenant leave, does it mean that it's a bad thing? It may be bad for a short period of time if the REIT manager is not able to find the substitute tenant to really replace their renter, right? But if the landlord is able to find a new tenant and also renew or not renew, lease it at the higher rental rate, and that is a non-issue, right? Take another example. Last year, it was reported that one of a tenant of Keppel DC REIT defaulted. You all can remember, right? So basically they're affected badly based on the news itself. But you look at this year Keppel DC performance. Keppel DC actually I think is one of the only REIT that actually still trading on the uptrend and also perform very well, right? And the tenant issue, nobody gonna mention it anymore. So for me, it's just a market noise. At the end of the day, they can replace a tenant, okay, based on a track record, because they have the marketing team, they have a leverage, they have a network to really get the new tenant easily. So for me, I would say that it's just a noise.
Makes sense, makes sense. Thank you, Kenny. John, I hope that answers your question. And maybe the last question for you would be this, right? So US have a few REITs. They were quite cool at the beginning, but since COVID till now, they seems to be still got hit very badly. So what's your view on the US REIT? Is it an opportunity, or do you think you should avoid until there is better clarity?
There is an opportunity, but investor really need to look at your own risk profile again, all right? So my view, okay, for me personally, personally I feel it's opportunity, my view, but not necessarily is suitable to everyone due to your risk profile and also your understanding of the risk sector itself, right? Uh, I think more or less we have passed the worst period of time during the high interest rate environment. Okay, the interest rate is start coming down. That will give some relief to the REIT manager itself. That's one thing. Second thing is you can see that actually those are big MNC, they are forcing the employee go back to office 5 days a week. That will really help the occupancy rate for the office space, and also the demand of the office may be coming back again. So that's a second point. And the third point would be, with the cut in interest rate itself, the portfolio valuation is expected to bottom out. It will start to increase. Okay, so if you look at this valuation itself, there will be another group of investor out there have a money and waiting for the opportunity to bargain buy all those commercial office, right? So when is the best time for them to start to do the transaction is when the interest rates start to come down and also the valuation has bottom, right? So when the valuation has bottom, it's time to really come and pick up again, right? That will cause a revival of the whole commercial office space in US, right? When it's going to happen, nobody know, but more or less that we know that we are close to the bottom. It going to turn. So it's very very important to really watch closely on all the market outlook on the commercial office published by this REIT manager, Manulife US REIT, Keppel Pacific REIT, and also Prime US REIT, right? So for me, I think that we just need to wait for the turnaround to confirm. But by the time everything is confirmed, maybe the stock price has already started to rally. That's a thing we need to pay attention to. Another thing is if all those financial number become better and better and they are able to reinstate their dividend. Do take note that because now they are suspended all the dividend, that's why all those big fund manager they are exiting the position because they are not paying dividend, they cannot hold their portfolio, cannot hold this REIT. So they have to sell those REIT. Then if the REIT start to reinstate back dividend again, and this big fund manager can also start to allocate back to this REIT again, then probably that is the best time. That's the time the share price will start to rally. So it very much depends on investor. You want to do the bottom fishing now with risk, and also you need to wait, or you want to wait for everything to confirm first, and the wait for the share price to really rally by 20%. Make sure it's on the uptrend first before the enter. It's very much depends on individual.
Right. Thank you, Kenny, for the insight. And with that, any last words for our attendees?
Uh, Actually, nobody can predict the market. It's very, very important that whenever we want to build our portfolio itself, uh, reposition ourselves as an asset allocator, right? Allocate our investment into different asset class. REIT can be one asset class, and you have the private credit and an asset class, bond and an asset class. If you change yourself to be asset allocator, you can really maneuver or manage your portfolio volatility much better because this world is really unpredictable. It's very, very difficult to really stay into asset class and also anticipate what's going to happen, right? Just be diversified and become the asset allocator.
Right. Thank you, Kenny. That's a very, very good advice. Be diversified, right? And allocate your capital accordingly. So if you need help, if you can't do it yourself, then please reach out to Kenny for assistance. Thank you, Kenny, for your time and for your sharing. And I'll see
Okay,
you
thank you, Richard.
again at our next session. Thank you, Kenny. All right. And now let me share my screen. Okay, coming back to the agenda, we have reached the third speaker and our last speaker for today, who is Mr. Ian Low. And he is himself a passive income investor as well as a remiser. So, without further ado, let me now hand over the stage to Ian to share with us his insights for 2025.
Hi everyone. Richard, can you hear me?
Yes,
Okay, do you see the mouse? And I
not
shall.
yet.
You don't
Not yet.
see? Okay.
Let's give it some
Okay. Yep.
time.
Yep. Yep.
You have started sharing already?
Started to share already.
Okay. Yes, I see your slides.
Okay. Now, okay. When I move my mouse, you can see.
No, I don't see your mouse.
Oh, okay. Okay.
Okay,
Oh,
now I
yeah.
see. Now
Okay.
I see.
Yes. Yes. Okay. Okay. Good. All right. Hi everyone. Wow. I enjoyed the talks by Kenny and Lee. They were very educational. And you guys who have stayed for the past 2 hours with us, well, I thank you for your patience. All right. If you need some time, go to toilet, take some water, but come back, and I shall begin right now. All right. Okay. I'll be covering the market outlook, but it's basically on how I invest, how I see things. So I'm not asking you to invest. I am actually sharing with you how I see the market and my strategy. All right. Okay, as this is a disclaimer that these slides contains my opinion and is for educational purposes only. It is not intended as a recommendation to buy or sell any stocks or bonds. I am not liable for any losses you may incur. All right. Without much further ado, let's continue. My name is Ian, and I invest primarily for passive income. In fact, if I put on my first hat, I am an investor myself. All right, I manage my own portfolio, and I focus mainly on passive income using local bank shares, corporate bonds, REITs, and real estate. All right, it is real estate heavy. Okay, and I'm also a remiser with Maybank Securities, and at the same time, I'm the secretary of Online Traders Club Singapore. Now, I put in red 2024. This was my overall plan for 2024. All right. This was not 2025. Last year, I think I may have given two market outlooks, and this is my overall plan then. All right. So I was building a war chest at the start of the year. I was telling everyone I will build a war chest using T-bills leathering in preparation for upcoming recession. But there's no recession. But I've later you see I've successfully managed to build a war chest. All right. Now, um, I also wanted to buy US to buy on dips. I've done that. And to exit the market when the Fed announced a rate cut. So somewhere in September, last year, 2024 September, I exited all my US positions. So I am sold out every single US share in September period. All right. September, October period. Somewhere at that window, I sold off every single one. And that is my war chest. All right. Okay. So I followed my plan for the start of the year and I executed it. As REITs and SC, I will invest using stochastic hook on the weekly chart. I did that, and I am holding mainly. I have a lots of REITs by using the stochastic chart. I'm REITs heavy. All right. Um, Hong Kong and China. So I entered at the early part of the year. For Hong Kong and China, and I have exited all my Hong Kong stocks by the end of the year. So now I've zero Hong Kong and zero China stocks. It's all gone. All right. So that was how my war chest is built. So now I only have Singapore counters and I only have local bank shares and Singapore REITs. Now, so Singapore S&P 500 went up 23%. Last year, Singapore went up 17%. Shanghai went up 13%. Hong Kong 18%. I think I did reasonably well last year. All right, but I'm in net cash in a lot of markets. So, what do you think I'm waiting for now this year? You can guess. I'm waiting for a crash. I'm waiting for a recession. I'm waiting for a black swan. I'm waiting for something bad to happen. All right. I think most of you is hoping for the market to rise. Yes, I have my bank shares, I have my REITs, but I actually hope for the market to crash. All right. Um, but let me tell you that it's not likely. So I think at this point to share with you that going forward, I think that the market should still rise with Trump being in power. But Black Swan is Black Swan for a reason. When you least expect it, something may happen. All right. Um, the next few slides, I shall be sharing with you how I see the current market or current economic situation. But V has done a great job, and likewise for Kenny. So I will be very quick, and I just use one sentence for each slide to tell you how I see it. All right. So basically, the news is saying to us that US inflation is forecasted to go lower. You can see here using the mouse over the next few months. All right. It will go lower. All right. And the Fed fund rate is forecasted to go lower over the next 1 year. All right. From about 4.5 to 4 to 4.25%. All right. Over here, I highlighted in red. In 2026 is forecasted to be 3.5%. Hold on. And in 2027, 3%. So I got this from the dot plot. All right. From the dot plot, over the next 3-4 years, if things go according to the dot plot, it will be 3%. It will be a very, very gradual drop. All right. Now, this is the Fed fund rate also, but it's not over the short term, but over the long term. Over the past 10 years, the Fed fund rate from close to zero went up to somewhere like 2.5. Because of COVID, went back to zero, went back to 5, and now it's about 4.5 now. I would like to ask you a question, all of you, and that is, do you think interest rate, the Fed fund rate, will go back to zero? Do you think so? I think for a lot of people, a lot of what I read in the papers, they are all saying that not likely nowadays. Inflation is quite high with the Trump 2.0, with all the tariffs, not likely. Well, I do not know the future, but this is okay. One of the most, whenever I see an important point, I will highlight. So this is one of the important points for today's presentation is, in my opinion, I think you go back to zero. It's only a matter of when. When will it go back to zero? All right. The question is when. And I want to present my case is interest rate will go back to zero in the next black swan. In the next black swan, the Fed will reduce interest rate back to zero and it will be zero, right? So it will be back to zero one day. I do not know when. And because of that, I know when I invest in REITs today, especially, even if it doesn't go up in price, eventually one day it will go back up in price because the Fed fund rate will go back to zero, everything will be reset again, and my REITs will go up in price one day. All right. So I'm adopting a very long-term view, not 1 year, not 2 years, possibly 5 years or more. All right. So what the news is telling us is that there'll be a gradual decrease of Fed fund rate from 4.5 to 3% in 2027 if all goes well. And there'll be a gradual increase of prices of bonds and interest rate sensitive property stocks like REITs. All right. This is what the market is telling us. And our previous speaker has also alluded to that. Um, but I think that in personally in the next 3 years, next 3-4 years, before it reaches 3%, I think a recession or a black swan will happen. All right, that's my view. All right, come on. In today's world, suddenly Zelensky is a friend of Trump, and sorry, Zelensky is a dictator. Suddenly, overnight, he's a dictator, and Putin is a friend of Trump. Things can just change overnight somehow. All right, in today's world, it is volatile. Um, So in this slide, basically is this, the Fed fund rate over the past 70 years, whenever there is interest rate falling, you see here interest falling, this bar is a recession. Interest rate falls, there's a recession. Interest rate falls, there's a recession. The fall of interest rates over the last 100 years, the last 80 years has always led to a recession eventually. All right. Likewise, without going to details, but basically, the previous speaker has also alluded to that also. When the 10-year treasury yield minus the 2-year treasury yield chart event is positive, sorry, is negative, it eventually leads to zero. So at this point, when uh, when it's below zero, eventually they'll lead to a recession. When it goes below zero, eventually there's a recession. When it goes below zero, eventually there's a recession. Likewise, it has gone below zero and now we are waiting for a recession. All right. I'm just saying what the charts is telling us. All right. Okay. So this is the S&P 500 chart and it's rising. And I think it will go higher. It will break new high again. Um, in the short term. All right, in the short term. But eventually, you can see here from the red arrows, if you see the COVID crisis, and you see here when interest rate starts to rise uh, in 2022. All right, the moment the news was out that even before interest rate was rose, when with the Fed alluded to the possible rise of interest rates, the market starts to have a correction. All right. So I know eventually, I do not know when there'll be a correction. So market correction is a matter of time. All right. So now I'll look at the focus on Singapore. Singapore. All right. Um, Somewhere in January, MAS eased the Sing dollar policy for the first time since 2020. For the past 5 years, that means they weaken. They are going to weaken the Singapore dollar. All right. For the first time, they announced it that for the past 5 years, in this coming year, they are going to weaken for the first time. And there is some link between interest rates as to the Sing dollar. All right. So I expect also because of this, the Sing dollar interest rates will also come down as a subsequence. Um, the I'll be covering a couple of a few slides on the yield curves. It may take some time to explain, but maybe in just one sentence, without explaining the reasons, I'll just tell you this curve here. All right. This curve here, a straight line up like that, is called a normal yield curve. This line like that is a inverted yield curve. All right, this is inverted. This is normal. So normal is normal. Inverted means something is wrong. There may be a crisis, recession coming ahead. All right. This is the US yield curve. Okay. Now the dotted line is 1 year ago. The dotted line coming down in this pattern, is it inverted or is it a normal? Yes, you are right. It is inverted 1 year ago. The dotted line is 1 year ago. This way, this pattern is inverted. The fixed line without the dotted here is the current US yield curve. All right. It is no longer inverted, is normal. Here at this point, 1 year and above is normal, but at this little point it's still inverted. All right. Here is a bit inverted, but the rest is normal. Okay. Um, I'm not focused on US now because I'm holding all Singapore counters. So I am very focused on Singapore. All right. So Singapore is always a laggard behind US. So the short dated US interest rates, all right, came down in the past 1 year. Came down in the past 1 year. But the longer dated, for example, the 5 year interest rate in US for the past 1 year, okay? I'm not talking about the last few months, uh, like what V and Kenny was talking about. They were talking about the 10 years, and he said that the past few months, the interest rate came down. But on to you see here, it's over the past 1 year, it actually went up. the interest rates between 5 to 10 actually went up over the past 1 year because it was coming from the inverted to normal. All right. So some interest rate came down, some the short dated came down, the long dated went up. All right. And I propose that we are going to see this for the Sing dollar. All right. And now let's see the Sing dollar. Again, firstly, show you 1 year ago the yield curve of the interest rate for Singapore, and this is the current yield curve. All right. So 1 year ago, come down this pattern, it is inverted or it is a normal. It is inverted, and this pattern like that, I would still think inverted. So it's still inverted today for the Singapore dollar yield curve. All right. So it's still inverted, but however, if we follow US and correct I go to the normal yield curve, what is it going to be like? All right. So I'm going to focus on this part here. All right. I want to blow it up. So basically, is this? This is the current yield curve for the 1 year to the 14 years yield curve. Okay. It is here is inverted. Here is normal. All right. So it is going to correct itself. This is going to come down and this is going to go up. All right, then it'll be a straight line. Now, what is the implication? These are the T bills. All right, the T bills is going to come down from about 2.95%. It's going to come down. All right, and yes, I know the SSB likely will interest rate should come down for the 1 to 10 years. It should come down, but there'll be also a slight push up to correct itself. All right, so what's the implication? I think that with the correction, this is the implication. All right. SSBs and in the T bills will tend towards 2.5%, especially the T bills. All right. And there is a chance that corporate yield bond and maybe SSB may even rise a bit for some time of the year. All right. To become more attractive. Yes. If it becomes a normal yield curve. All right. Okay, this is SSB's historical rate. I think it should move towards 2.5, but there's a chance that it may bounce back up for some months. All right. So, by the way, I think that in case I forget, this current month's SSB, uh, it closes end of this month, February. All right. I think basically, I am saying that this current month's yield is a good yield. Next month, you are not going to see such a higher yield. Next month's yield in March surely drop. All right. So before in case I forget, take a look at the current month's SSB rates. Apply before the end of the month. If you like it, go and apply because next month it will drop. All right. Okay. So this is the 6 months SGD government bond yield. I actually follow this chart, and in fact, before I apply for any T bills, I will look at this chart, and if you check the T bill rates, because T bills are auction. You need to apply. You need to put a bid of the what's the cutoff you want, or else you may not get it. All right, so I always follow this. You can use this link on the day of the of application. I will take a look and try to guess what will be the T bill rate even before it's announced using this chart, and it's fairly accurate. To me, it's the closest estimate of the T bill for that month. All right, but basically likely to come down to 2.5%. All right, this is how I see it. So as T-bill moves from between 3 to 2.5%, it is no longer interesting to me. And this is not only for me. Straits Times, Business Times author Jude Chan said on February 13, sorry T-bills, it's time to look elsewhere for you. All right. So for him, it's as reads, yes, it's okay. Um, fixed D is not okay. You see, 1 week ago, DBS reduced the fixed D by 0.75%, just 1 week ago. So now if you check the T-bill now for 1 year is 2.45%. And do you know that 1.5 weeks ago, if you log into DBS website, it's 3.2. From 3.2, it dropped to 2.45 1.5 weeks ago. All right. So is rates will be dropping. All right. So now my war chest is SSB, and I've already finished my 200K worth of SSB, so I cannot buy more. And all my SSB are all above 3%. All right. So I cannot buy more. Currently, the one in the market now is about 2.9, so it's not bad. T-bills, I will be exiting. I will no longer apply T-bills, and those that mature, I will stop, and I will be buying into money market funds. All right. Okay. So I estimate between 3 to 5% for SGD, but note that it's not capital guaranteed, and it has some drawdown. Okay. Now I went to one of the funds, and I just share with you. Basically, this fund that I invest for the money market fund, I shan't share with you the details, but its projected yield is 3.1 to 3.4%, and the historical max loss history, the history max loss is 0.05%. So this is acceptable for me. So so I prefer this than T bills for the time being. All right. Okay, my compared to 15 years ago when I did quit my full-time job to trade for a living and now to invest for a living. All right. Um, a lot of changes in how I do things, but it's mainly because of my lifestyle. All right. So 15 years ago when I started, I was trading intraday. Can you believe it? Uh, 2010 when I quit my job of trading intraday. Then went into swing trading. Then I went into position trading. And now today I am a passive income investor. All right. And it's not because one method is better than the other, but it's really because of the lifestyle changes. All right. So in the past, I was focused on capital gain. And I wanted to use very little capital because my children were still young, and I I need money to feed my family. So I want to use as little as possible. So I buy high to sell higher. I hold for short term. Fundamental analysis FA is less important. And when the price drops, I'll be sad. All right. When cut loss, I'll be sad, frankly. All right. And it's time intensive because trading for a living is really a full-time job. Today, I'm investing, and it's for passive income and requires a lot of money. All right. It requires a lot uh, compared to trading. And you buy low and sell high. And whoa, this is not very nice. Okay. I never sell. All right. I almost never sell. All right. Almost never sell. And FA is my fundamental analysis is more important. When price drop, I'm happy and I buy more. So in the example of someone asked the questions to Kenny about Maple Tree Industrial Trust, the price dropping. You know what? I'm happy. I'm happy and I buy more. When DBS keep going up, when I have a lot of DBS shares, I got a lot of UOB shares. I'm not happy. All these shares keep going up, I cannot buy. I want the bank shares to come up for me to buy. But MIT is coming down. I'm really happy and I'm buying. All right. So and I do that and I check my positions once a week. All right. So in a uh, I'm this is the S&P 500. All right. And for a lot of the years, a lot of the past 15 years that I was doing this full time, these are the indicators that I will use. And give you an example. All right. When it goes below the moving average, I will sell. When it goes above, I will buy. When it goes below, I will sell. When it goes above, I'll buy. All right. Or you can go below the MACD, you sell, and go above, I'll buy. Go below, sell, and here I buy. So I was actually doing position trading, taking positions for many months. All right, I will buy and sell, but I was taking position, and I like this. This is still a very good method, and I did this for many years. Okay, um, and by the way, I still think S&P 500 will go up. All right, but I think it's a matter of time. The S&P 500 will come down again, and yeah. And for myself this time round, I'm using stochastic 1 month, and I will only buy during when they do a stochastic hook. When they do a stochastic hook, it tells me to go in, and I will go on the lower time frame. I will not use monthly. This is for analysis. I'll use the monthly S&P chart, but the entry will be on using the weekly. All right. So you can tell these are the periods that I will enter only, which is during market pullback of at least 25%. All right. These are at least 25% pullback. All right. So until it comes back to be by 25%, I wouldn't be buying S&P again. Um, Shanghai. This is Shanghai over the years. And to keep things simple, I have drawn some lines. All right. So Shanghai to me is fair value. All right. Because it's close to my higher point. All right. For me to buy now, I can buy, but it is to me it's a fair value. But I prefer last year. Last year at the start of the year, it was lower. All right, it was lower. It was here. So somewhere here is definitely a buy. Somewhere here is not really a buy. So so another thing, if can a takeaway point for you is that so I'm not buying the Chinese stocks at this point. And I missed out on the Alibaba run because I sold much earlier, right? So but uh, because I still want to participate somehow in China, I see myself entering China market via stocks like Maple Pan Asia Commercial Trust. All right. So later you shall see the chart on Mapletree Pan Asia Commercial Trust. It has pulled back, and I would use Pan Asia Commercial Trust as a proxy to enter the Chinese market. All right, it's because it's still fair. It's fair. I don't mind going, but I will use something I'm very familiar with in Singapore to go in. All right. So likewise, Hong Kong it's also fair value. It's somewhere halfway between my two lines here. So last year was a better time to go in as an investor. Now I don't think I'll go in, but again, there are a few counters like Mapletree in Pan Asia Commercial Trust, all right, and also Mapletree Logistics as a proxy to enter. Now this is STI, all right. So um, to share with you another takeaway for you, one of the important lessons that I learned through the years is uh, it's important to have a war chest. All right, it's important. There were many crisis years when I was fully invested and the crisis happened and the market had diarrhea and I had no money to invest because I was fully invested and my counters dropped by I don't know 40% and I couldn't enter. I originally thought that when I bought into bonds, I can exit my bonds to sell shares, to sell my bonds to enter during the crisis. But you know what? In today's market, when the market drop, lao sai, lao sai is diarrhea. When the market have diarrhea, shares drop, bonds also drop. All right. So bonds drop, and I finally had to exit my bonds to buy shares. So one of the important lessons learned was to always keep a war chest uh, hard times. All right. So fortunately, during COVID, I was lucky enough to have a war chest then, and I was able to buy DBS from When it was 24, I started to buy. When it was 22, I continued to buy. When it was 20, I buy. And I was happily buying. It was a happy time to buy. When I even bought DBS at 16. Can you believe it? All right. If I buy 16, do you know what's my dividend yield now for DBS when I buy at the price of 16? All right. At this point, DBS at 47. Do you know what's the yield at DBS at 47? Now, the dividend yield when the price of 47 is 6.5%. You know what's the dividend yield? It's crazy, all right. Okay, so I'm still holding today, and my strategy for such counters is don't ever sell, and I will only add. All right, I will only add. Of course, if I need money for any thing in my household that I need, I may sell it, but I wouldn't be selling my DBS shares to buy other counters. I'm not doing any sector rotation, or to take profit of the bank to buy REITs. I gave up on the idea. All right, okay. So in fact, I will only uh, because of the war chest now, I will use my war chest to enter the banks when it drop a lot. All right. All right. So at this point now, I think it's okay to buy STI because I think Singapore is strong. I think STI can only go higher. It can only go higher, and it may possibly break new high. And uh, but I will not be adding aggressively at all. All right. The stochastic hooks here are where I will add aggressive, not at the current moment. All right. This is where the opportunities are right now. I totally agree with Kenny. I feel that as REIT is at a good price now. Uh, um, I'll share with you how I invest. I think for Kenny, if I can explain in one sentence, he's doing a top down. I'm doing a bottom up. So for myself, I do a bottom up rather than a top down approach. But eventually, in choosing the REITs that we go in. So over here is closer to the low. So it is the point that where I will. It is the best time now. All right. So uh, if you look at this chart, this is really the best time. So is there a possibility that REITs continue to drop like the 2 week price? Yes, there is. Yes, yeah. It's not like it sure go up, all right. But I know even if it drops, eventually you go back up. You know when? You need after the next crisis. When the next crisis, now interest rate will come down to back to zero, and when it recovers, the REITs will go back up again. Now, typically, this is what I went through recently. Person A asked me, "What to buy, Ian?" For me, hey, REITs. Are you sure? Are you sure? I'm starting to hate REITs. All right. So I can understand. Uh, REITs have fallen so bad over the past few years that it was once a darling of Singapore investors. Now there are people who hate REITs now, and they can't bear them. They can't see themselves buying into REITs now. All right. But this is now people are fearful about REITs, and that's why I think it's good to be greedy. And I comfort myself, and how I assure myself is I know interest rate will go back to zero. I will tell myself I know interest rate will go back to zero one day. I do not know when. I know it go back to zero, so I dare to buy. All right. So past 5 years, very few people have made money in REITs. All right. But it's very good for me for passive income. All right. So I enjoyed passive income. Why am I still interested in REITs? Because I keep asking myself, when will interest rate drop to zero again? And I know it's a matter of time. All right. Now, what REIT can we hold for the long term? Consistent DPU, strong sponsors, preferably linked to the government. All right. So basically, uh, this is very simple. What to buy is simply these two rules. For myself, I would like to keep things simple, and I follow these two rules. Of course, I will see many, many other things, but These are the two main indicators that I use. All right. All right. So I shall give you an example, not in REITs first. This is OCBC Bank. Why I say OCBC Bank? You have seen DBS announce fantastic results. You have seen UOB announce fantastic result, and next week is the OCBC's turn. Is it a good or bad results? I think it will be a fantastic result, and they will announce how many millions will be given to the investor over the past over the next 3 years, just like the other two banks. It's a given, all right. It will happen. So I think it's going to rally for OCBC. So for OCBC, if you see past 10 years, rising dividend. The only time that it drops is in COVID. All right. After COVID, continue to rise again. So this is the things about bank. For banks, not just the past 10 years, as far as I know, the past 40 years, OCBC has been paying dividends in through the recession years, through the crisis years, through the SARS, through every year, they always pay dividend and the dividends have risen through the years. All right. So when you buy OCBC at 6% now, 10 years later, it may not be 6%. You may be yielding 10% in 10 years' time because the dividends will rise over the years. So likewise, I'm applying for REITs, all right? So these are examples. So, okay, man, by the way, go back. This is 2015, this is 2024. It is going this direction, all right? These are left, right to left, right to left. So Parkway, this is also a REIT that from right to left, it has risen through the years. Now, how do I read such chart? So basically, how I see this, I want to see at one glance, is it rising through the years? And I will also see the past 1, 2, 3 years, is it rising? All right. The past 10 years and the past 1, 2, 3 years. So Parkway has done well. And that is why you buy now, the yield is only 3.5%. All right. So I'm asking you to buy. Actually, it's a very strong counter, but you buy now, you get 3.5%. Now look at the retail. All right. Star Hill Global. This is a negative example. 2016 it was high. Now is low. So for Star Hill Global, over the years, the dividends have been falling down. All right. Suntec REIT over the years is coming off. All right. So these are the counters I will not touch buying their shares. I may buy their bonds, but not buy their shares. All right. American, is it good or no good? Not bad lah. Quite stable and I think going a bit up. All right. It's going a bit up and it's rising. Hey, interest rate starts to rise in 2022. And yet they declare higher earnings this year at the higher interest rate compared to last year. So Paragon has really outperformed. They have been done very well. But because they have done so well, the share price is still stuck in that low prices. Paragon has offered is doing a corporate action to buying back. So no chance to own this REIT anymore because they are buying back. They are going to privatize because this is a good REIT, all right. Now Centerpoint, Fraser Centerpoint Trust, stable and overall is higher, all right. So it's going up, stable, and over the past 1, 2 years is coming off a bit, but it's acceptable. To me, there's a reason because we know interest rate has risen this year, this past year. So going down a bit is normal, all right. So this is a good counter, Fraser Centerpoint Trust. Commercial, so a negative point, I will not touch. I'm not asking you not to buy. You can buy. The dividend yield is 7% now. You can go ahead to buy, but for myself, I will not touch it. And I tell my clients who call me, I tell them 7% you go and buy, but I will not touch it, right? Because the DPU has been falling. All right. Apple REIT, I will not touch also. I see my clients buying, but if they were to ask me, I will not touch. It's falling. CapitaLand Integrated Commercial Trust. Because there was a corporate action a few years ago, we don't have a full 10 years. But you can see overall, as an office, as a retail, is rising. This is a very good read. I have been buying and I am still adding. All right. So at this point, I'm still adding this point. So I have a pending order to enter. All right. So I move on. Industrial, some negative example. I used to like some of my clients will know. I used to like Fraser's LNC, so it was rising in the past. It was rising, but in the recent years it has fallen. So I sold it. I sold already, so I don't have anymore. So I this counter hasn't outperformed. So I will rather sell this counter to buy other REITs. All right. So other REITs that will outperform the market. AIMS APAC is not a bad read. I quite like it. It's for among the smaller Singapore industrial REITs. It's not bad, but I will still not buy it because generally the past few years is stable, but overall I still think it's coming down. All right, but you shouldn't look too much into this in the past because it was probably by the there was a situation in the past. All right, so, but generally, it's still not something that I would buy because the sponsor is not belonging to the government. All right. ESR REIT, one of the worst REIT that I know. All right. I always doing corporate action that is dividend yield, not accretive, but the negative accretive. I do not know what is negative equity, but it's dividend that is negative accretive. So and here the DPU is coming down. All right. So um Kaplan Ascendas DPU, I would say not bad. All right. In the past it was doing better, but right now with high interest rates, they are still doing okay. All right. They are still doing okay. So I don't mind buying it now. All right. Um Maple Tree Lock, fantastic performance all these years. And I think the recent DPU and recent earnings is coming down, but I think this is only a blip. In the long run, the share price coming down, so I am very happy. The more it comes down, the more I'm happier. All right. Maple Tree Industrial Trust, likewise, strong DPU, strong earnings. The Kenny has correctly said it's noise. when the when Morgan Stanley said have this report about it's a 5% DPU that will fall this coming year. They predict a 5% DPU fall because of the vacancy, assuming they cannot find a tenant. It's only 5% DPU, all right. Come on, this is noise. To me, it's noise. In the long run, it will outperform because I trust in the sponsor. Likewise, Apple BDC, uh, the exact situation when Kenny explained about 1 year ago where there was a negative news and the price came down. I like to tell you that I bought. All right, so I'm one of the happy investors that bought when price came down. Likewise, China. All right, so I'm not asking you to buy Kaplan China. This is a strong sponsor, but I think over the years the DPU has come down. So uh, I'm very tempted because the price is so low now. I'm so tempted to buy, but I have to control myself not to buy. Okay. And this is the better counter. Maple Tree in Pan Asia Commercial Trust. Rising DPU coming off recently, but strong manager, strong REIT manager. All right. So basically this is a summary of my I'm only wow, my maths is terrible. It should be 4, 5, 6, 7, 8. 8 counters, all right. 8 counters that I will enter. So I don't plan to diversify. I'm not looking at the sector. I am not looking at the. I'm simply investing them just like I invest in DBS, UOB, and OCBC. I just buy a bit of all of them. All right, and of course, everyone favors their favorite. I favor DBS. So for this list here, I favor Fraser Centrepoint Trust. I favor CapitaLand and Maple Tree Industrial Trust, Capital DC, Capland, Ascenders REIT. Parkway, the yield is a bit low. All right. Now, what do I not favor? Basically, I favor Singapore counters. So, not same. So sorry, not Singapore. Singapore REITs with Singapore properties. All right. Maple Tree Lock, I will just buy a bit because it's I think about 20% or 15% Singapore. Maple Tree Pan Asia is about 50-60% Singapore, all right? Maybe 50%. And 40% was China, is China and Hong Kong. So when I buy Maple Tree Pan Asia, I know I'm buying into China, buying into Hong Kong. So I hold that. I'm happily buying into Fraser Centrepoint Trust because it's totally Singapore. Capland, CICT is almost or completely Singapore, all right? Ascenders is like 80% Singapore. Capital DC is also very high in Singapore, right? Something like 80%. Maple Tree Industrial is like 60% Singapore. I favor Singapore counters in short, all right? So I believe in the Singapore story, and just for the sake of these coming elections, I urge you to invest in the man in white, to put your vote on the man in white, because they have done well. All right. Now, what to buy? All right. When to buy? Sorry, when to buy? Only one chart. All of you know that I favor this method, and there's the weekly stochastic hook. All right. So Maple Tree Industrial Trust, I will show you that these are when they have a hook, when there's a hook, these are the times that I will buy. Yes, it's not perfect. Now it has got even lower, but I have enjoyed the dividends. I bought low, and I know that I only buy when the price is low. And over the long run, next year, in the next 10 years, I believe it will go up. All right. So I have no issue. And in fact, buying the bank shares during COVID at low prices gives me a lot of confidence now to buy the REITs low. All right. So, yeah. Corporate bonds. All right. Um, One slide here just to tell you that corporate bonds, you need to be AI. AI means you need to declare to Maybank that you have at least $1 million. Okay. If not, you cannot buy corporate bonds. All right. You generally cannot. There is still a ways to buy, but it is better that you are AI. All right, accredited investor. Now, familiar chart again. This is the 5-year SGD government bond yield. All right. Now, okay, it's not it's not 5 years. I will amend. It's the SGD. It's the SGD government bond yield. All right. So typically bonds, I would say most bonds in Singapore is between most corporate bonds is between 1 year to 5 years. Is in this space here. All right, 1 to 5, and this is government bond. All right. So if you estimate, if it's a 1-year bond, 2.59%, 2.95%, you plus another 1% because it's a government, it's a, let's say, Maple Tree. You expect Maple Tree bonds to be about 3.95, right? You typically add about 1%, 3.95%. All right. So likewise, if it's 5-year, this is about let's say 2.8%. At 2.8%, for a 5-year Maple Tree bond, it will be about 3.8%. This is how you aggregation you estimate. Okay. Um, Having said that, I go back here again. I expect this to go up and I expect this to come down. All right, because there will be from inverted to become a normal yield curve. So it's just a matter of time. So what's the impact? I think there is a chance, even though interest rates is going to fall and bond prices expected to rise, yields may fall, but the 5-year bond may actually go up. All right, there is a chance that 5-year bonds may actually go up for Singapore because of the from the inverted to normal yield curve. Um, and there you see, just now I was telling you I expect the Temasek related bonds to be about 3.8%, but actually it's trading at about 3.05% only. These are all Temasek bonds, you see. 3.35, 2.85, this is 3, this is about 3%. So instead of the Temasek bonds, instead of trading at 3.8, it is only trading about the government rate, like the T-bill, yield 3%. Because I because Singapore is yield curve is still inverted. They haven't uninvert. When it uninvert to a normal, there will be a shift. All right. So frankly, to tell you from this, these are the different maturity. These are the yield. There's nothing much to buy. The highest here for Temasek was 3.35%. There's nothing much to buy. All right. Likewise, a REIT bond. This is a REIT bond. At 3.8% is OUE. OUE REIT bond is that means it's an Indonesian REIT bond is at 3.8%. Frankly, not exciting. There's nothing much to buy. All right. So likewise, these are REIT terms. REIT terms. All right. And the these are what most of them are around about 3.9%. So you want to buy a perp today, it's about 3.9% only. All right. This past 1 week, there were land lease perps at 4.7 and new. So for a new issue, you get 4.75. There was a Guaco land perp at 4.35% this past week. So it's possible somewhere at 4 point something, you get a perp. All right. But you have to buy from the secondary market. You get the ESR, you get the first REITs, the Indonesians, the and the ESR REITs. All right. So I wouldn't touch these REITs at the moment. All right. So frankly, my conclusion from this slide, there's no real bonds to buy. Okay, at this moment. Likewise, the bank perps is trading about 3.5% only. So you want to buy a bank perp today, you get 3.5%. It's possible to get a bank perp at 5%. You have to buy the Barclays. All right. The Barclays is somewhere at 5% today. You can buy it. The HSBC is somewhere about 4.4%. Go back, take a look. If you like to buy these perps at these yields, I put down here for your consideration. But to me, nothing really interesting for me. All right. I would rather keep my money as a war chest for a market crash rather than to buy a bank perp at this point. That is my opinion. These are some interesting bonds I've highlighted. If you are happy with about 4%, there are some uh, bonds that may be interesting, all right, but nothing fantastic. So I will move on. Again, the Olam Pub is about 5.5%. Nothing fantastic. Um, so I shall move on. All right. Currently, this is my portfolio. So I built now a war chest, about 1/3. My CPF, annuities, insurance, and all my insurance, all right, and annuity CPF is here. and my bond, shares, REITs, private equities are all here. All right. So I'm waiting for a market to crash. If there's no crash this coming year, I think I will be adding some more any annuity. All right. I'll be adding some more. I want my watch shares to be about 25%, 25%. And I'm adding a bit of REITs. I'll be buying a bit of REITs and buying a bit of annuities, make it to 25% if there's no market crash. All right. If there's a crash, I will deploy my war chest. Basically, is this in one slide, my overall plan for 2025. I shall guard my war chest. When I say guard, every day is so tempted to use my war chest to buy something. All right. But I shall guard it, be very careful, nimble at the most, but I shall wait for a major pullback of more than 25% before I deploy my war chest. When opportunity arise, I may nibble on local bank shares, very short-term opportunistic, all right? Buy and sell. REITs, adding to my long-term portfolio. Bond, if there is a new issue that is good, I will buy. Private equity, I shall not talk about here, but I have been looking at private equity, all right, and the annuity plans, all right. And all in all, whatever all this here, I favor Singapore asset. So you tell me somewhere in London, I'm not interested. You somewhere in Hong Kong, I'm not interested, all right. I favor Singapore assets. I'm becoming risk adverse. This is my retirement money and is for me and my wife retirement. All right. All right. So I have finished. And this is, you can keep in touch with me by joining my mailing list at Wealth Lions on my Telegram channel. You can also get my contact through this website. All right. And I am very open to having a coffee with you. Zero obligation, simply to discuss about retirement, to discuss about investments, and maybe even about my hobbies, cycling and running. All right. So and another thing, well, one of my favorite topic now is CPF. I'm 55 years old, so I think I'm quite an expert in CPF right now. I think all these years I've been an expert in CPF, but 55, I think I know a lot more because it's a crucial year for me. All right. So, Richard, you can take over.
Great, thank you, Ian. Wow, what an intimate sharing. Always looking forward to your sharing during the outlook because you share your personal outlook as well as your personal plan on what you plan to do with your finances. I think that gives a very, very good insight into what a practitioner, what is a person doing with his own money, and a good reference, a role model for some to perhaps even follow. So thanks, Ian. Thanks for your insightful sharing. Right. So for all the attendees, thanks for hanging in there with us all this time. If you have questions for Ian, please type into the chat box that you see on the bottom right of the screen. And if you're on a mobile device, please type into the chat box by scrolling up or down and look for the chat box. So one of the questions that I saw earlier about the that is perhaps Ian, you'll be in a better position to answer is whether is it still a good time to invest in Singapore banks since their dividend yield is like 5-6% kind of range currently.
Hmm, Good question. Thank you. Um, it really depends on your objectives, and in the long run of 10 years, I think the DPU of the banks will continue to rise. Over 10 years, 10 years, not over the next 1-2 years. Over the long run, it will rise. Okay, so in the long run, um, if you are a trader, And for myself, I I will put on my hat as a trader when I say I want to buy the banks now. It is really buy on rumor, sell on news. What I'm trying to say is you DBS announce good news, UOB announce good news, OCBC will announce good news. Likely, it's not a whale, but very likely will announce a bumper package for the investor. All right. So this is still a rumor, buy on rumor. And when the news is out, when the price has jumped up, uh, likely I will exit. All right. So sell on news. Um, for me to invest, for myself to invest in the banks, I prefer to go in during market crisis. I I have very good experience and entering it during COVID time, so I would wait. All right. So when I say crisis, there needs to be a major pullback in S&P 500. All right, by 25%. All right. So if there's no pullback in S&P 500, I will not be entering into the banks as an investor. As an investor, that is for myself. I hope that
Thank you,
answers
Ian.
your question. Yeah.
Okay, Andrew, that's a question from Andrew. I hope that answers your question. Okay, last question for you, Ian, and that is coming from John, and he's asking, instead of picking individual REITs, how about the REIT ETF?
That's another good questions, and a lot of my clients like to buy ETF, and ETF you are buying into bucket of stocks, and I think it's a very good idea. It if you are working, you have a job, you have no time to monitor. I think buying ETF is a very good idea. Uh, but if a person has like me like to go into more details. I like to beat the market. The market is the ETF, all right. I like to beat the market. I like to select company REITs that outperform the ETF, and that is why I prefer to invest in individual stocks. All right. So so for REITs, I surely will be buying individual counters. All right. However, for S&P 500. I love the ETFs. All right. S&P 500 ETF, definitely, because I'm now a passive income investor. I have no time to look into individual US counters. So I will really buy into the S&P 500 ETF. I give you some ideas. Like, for example, this question, a lot of clients ask me recently because this is a different question, but I will say it for it's I'm sharing because I think it's a very good idea. Um, Clients ask me, for those turning 55 and beyond, the CPF will not have any SA anymore. What to do with the money? So using your CPF money in OA that only earns 2.5%, you can actually use it to invest in S&P 500 ETF. Likewise, do you know that you can invest in government and quasi-government bonds ETF? Nico AM has a quasi-government bond ETF. All right. So that to me should outperform the 2.5% of the OA. All right. So to me, ETFs still have a role to play in certain purposes for me. But definitely read ETF, not for me. But for a lot of my clients, yes, I help them to buy the REIT ETF. All right, but not for me. All
Right,
right. Yes.
understand. Thank you, Ian. Okay, one more question just
Yeah.
squeezed in from
Yeah.
Han, and he's asking, what is your main catalyst to want to re-enter the Hong Kong China market? So this will really be the last question.
Okay. Thank you for your question. Uh, for me to re-enter is simply uh it is like I don't want to have a market run away without me. It is so there is a chance that the China market continue to rise, and yet I have some concern. So I will usually put a small amount. So but yet I'm not so confident. So as I said, so I will use the REITs that I know, those exposed to China to go in. Um Now, it's the same idea of buying just a little bit of Bitcoin. It's the same idea, just buy a little bit of gold, all right? And it's you just buy a little bit because you do not know when it will go up, all right? So yeah. All right, you now I am not asking you buy Bitcoin. I'm asking you buy gold. All right, because that is not my focus at all. But I like to have just a bit there, just to comfort myself that it's there. So so definitely China is not my focus at the moment. Yeah.
Right. Okay, Han, I hope that answers the question. And thanks, Ian, again, for your insightful and intimate sharing of your plan for 2025 and beyond. So, any last words for our attendees?
No, I would say that keep in touch. Ask me out for coffee. All right, and have a good 2025.
Right. Thank you, Ian. And thanks to all the attendees for staying with us till now, as well as all the speakers for sharing your insights for your outlook for 2025. And again, please remember to join all our Telegram channels so that you can be kept posted of upcoming webinars and seminars, as well as market insights. And thanks everyone for coming for the OTCS Outlook 2025. So I'll see you at the next event. Bye bye.